car loans and even stocks. And speaking of stocks, here's how your money looks right now ahead of the Federal Reserve. The Dow's down 70 points. That's a whopping 0.1%. The NASDAQ, though, Kelly, continues to be the story. NVIDIA, we'll get more on that, down again. NASDAQ down 0.8%. The yield on the 10-year Treasury note, again, this could all move on the Fed. I don't think we will see a big move, but you never know. 4.56%.
We'll see if we get that dovish pause that Tim Seymour was looking for last hour. And as Brian mentioned, take a look at shares of NVIDIA, taking a dip lower today and right near session lows after reports last hour that the Trump administration is considering restricting its exports to China. NVIDIA shares are down more than 6% now, and that's exerting that extra pressure across the NASDAQ.
All right, so that is all coming up, but let's right now get to your big Fed panel with some of the brightest names on Wall Street. David Kelly of J.P. Morgan Asset Management, Stephanie Roth of Wolfe Research, and Jim Caron of Morgan Stanley Investment Management. David, it's been like 7 years since we've talked, so I'll start off right with you. What do you expect from the Federal Reserve today?
Well, no change in rates, and I think they're going to try really hard not to attract any attention. I mean, the economy is pretty strong. Inflation's still on the high side of 2%. The unemployment rate's low and stable, so there's absolutely no reason to cut rates at this point. But they don't want to get pulled into a conversation with the administration on rates. So I think they're going to say no change, and they're going to say it as quietly as possible.
Okay, now I don't know what we're going to talk about for the next half hour. I'm kidding. Stephanie Wolfe, I mean, would you agree with that? And if so, what will then the Fed headline be? Because the Fed does nothing and says nothing is not really a headline that we want to have.
Yeah, totally fair. And I very much agree with David that we're likely to see hopefully nothing. It should be a quiet meeting if all goes according to plan for Powell. The things that will come up as a potential headline are how the Fed's looking at tariffs. Are they going to see through it like they talked about in the September 2018 Teal book, or are they going to have to react in a more hawkish way, which was a negative one for markets? And then, of course, how are they going to be thinking about immigration? Now, Trump has already announced some policies that are going to be reversing what Biden had put in place in terms of immigration. So we're going to have a reduced labor supply. So how is the Fed going to be thinking about that? Is that going to be factoring in a potential for a lower unemployment rate and some upward pressure on wage inflation?
Yeah, so David thinks we could be on hold indefinitely. Stephanie, you've gone to one cut from two. Jim, you think, well, what do you think?
So I think it's somewhere between 0 and 1 cut this year. Look, for me, it's always about the labor market, and I'm surprised at how strong the labor market's been. So I'm looking for hints from the Fed. How seriously are they taking this recent data in the labor market, which has been very, very strong, and how much are they extrapolating that into the future, or was this just a one-off? The other thing I'm going to look at for the Fed is how serious are they about getting to that 2% target inflation, or could they live with somewhere around 2.5%, and is that good enough?
Right, and as we all know, that makes a big difference, a little bit over time, and also in terms of what they decide to do on it. So we've got the pre-market set up, and a dovish hold maybe might be the consensus, maybe a cut or two, and we just heard Jim's between 0 and 1 cuts for the year, Brian.
Yep. And right now, let's get to Steve Leisman and the Fed's decision and call on rates. Steve.
The Federal Reserve maintaining the funds rate in the range of 4.25% to 4.5%. They did say that inflation remains elevated as it had last time, but they crossed out a line this time saying that inflation has made progress towards the 2% objective. I'm not 100% sure what that means. Perhaps we'll ask Powell about that. Is that hawkish or just getting rid of a tired old phrase? They say labor market conditions remain solid. They had said that they had eased, so they did an upgrade of the condition of the labor market, also noting that the unemployment rate has stabilized at a low level. The economy, as they said last time, is expanding at a solid pace. The committee is watching risk on both sides of its dual mandate. The statement says the committee is still considering the extent and timing of additional adjustments. No hint as to when that might happen or by how much, and no change to the balance sheet reduction plan. They'll keep reducing the balance sheet as they have been. As the statement has said in the past, it says they're prepared to adjust policy as appropriate if risks emerge. And we have a unanimous decision with new voters for the new year. January 2025 is when they turn over. We have Schmidt from Kansas City, Collins from Boston, most of them from Kansas City and Gouldsby from Chicago. So a bit of a Midwest contingent voting this time, sans Minneapolis. So back to you guys. Very much a staged statement, not much going on. And I don't know, Brian, can I use the phrase I reserve the balance of my time and send it over to you?
Well, wait a minute, Steve. You can't just drop it like it's hot, because I'm just going to tell you, Steve, what you just said. I'm going to quote Steve Leisman and Steve Leisman. Labor markets are solid. Inflation may get better. Considering additional timing of moves. This sounds like a Steve Leisman quoting a Fed ahead of a rate hike, not a rate cut.
You know, I guess so. I mean, I don't think that they're there at that point yet, Brian. I think the idea that the labor market remains solid is a positive that Powell and the Fed have that allow them to figure out which way they want to go with rates. But I still think there's an inference in the statement when they say, in considering the extent and timing of additional adjustments. And by the way, Brian, you do add the important point here, which is that one of the keys that I've been saying to this meeting is, does Powell affirm that with all the other things that are going on that y'all were talking about in the last segment, tariffs and tax policy and all the other stuff, will he affirm that the direction of travel is still downward? That's really important. Is he still confident that inflation is moving towards the 2% target? Those are the two monetary policy keys as I see them to the press conference that's coming up.
Quickly, Steve, usually the big mover when we get the statement is also the projections, the dots, as I won't call them. But we did not get those this meeting, right? Which makes this a little bit, less for the market to kind of sink its teeth into.
Right, no dots. The dots come four times a year. I have no problem saying dots if they want to fire me for saying dots. By the way, this is a little inside baseball where we had an old boss who didn't like us to say the word dots. I don't actually know what the new policy is, but in any event, they come four times a year. There is one question, Kelly, we might ask the chair, which is he did answer it one time, and we said, hey, if you were to do the dots now, are the old dots still good? That might be an interesting question, though. I don't know that enough has changed now to ask him that question in terms of, you would say, well, I think the two cuts are still something that the Fed would more or less back. Remember, it was a close call last time.
Yeah, no, actually, that would be a good question. Would anything maybe change those projections? Steve, thanks. Let's turn back to the panel for more thoughts here, and maybe we'll go in reverse order. So, Jim, the 10-year, it's up like a couple of basis points, not a huge mover so far. What jumps out to you?
So look, I mean, effectively, there's a long period of time between the next meetings. So the next Fed meeting is March 19th. We get a couple of labor reports. We get a couple of inflation data points. We have a new president, new policies that are coming through. I think the Fed is right to be paused and be as really obscure as they possibly can at this point. So what's really jumping out to me effectively is how the Fed is thinking about the labor market. I think the inflation component is pretty well entrenched. It seems like it's relatively low and stable, and that's what I expect. But it's really the labor market. It's all of the adjustments that we get. We get these QCEW adjustments that always adjust things down, so the labor market may not be as strong as a headline number suggest. And I think that's really the worry point for the Fed, is that they're just not 100% certain on how strong the labor market actually is or is not, and that's going to make them react to hiking, or not hiking, but cutting more so than anything else. I don't think a hike is in the equation for this year.
Fair enough, Jim. And Dave, I was kind of making a point because the commentary, David, has been so positive. It's kind of weird that we're talking about rate cuts, and the Fed has already cut rates, when a lot of the rhetoric around it is actually fairly good. That said, and I don't want to drag politics kicking and screaming into this. We try to avoid that. There's plenty of other channels that do it. But I think Steve's point was well taken, David, which is that if we don't know what the policies are ultimately going to be around inflation and jobs and immigration, whatever, isn't it much harder for the Fed to do their job, because they kind of got to wait and see what some of these policies are?
Well, that's right. And if you sort of go back 6 months ago, I mean, 6 months ago, you could have said the unemployment rate's going up, but maybe it's not a problem. Inflation's coming down, but and maybe it's going to head towards 2%. Now we sort of settled into really very close to an equilibrium, but it's a hot equilibrium. We've got inflation a little bit above 2%. We've got an unemployment rate pretty low here. And then all the risk in terms of, what do we do in tariffs? What do we do in immigration? What do we do in fiscal stimulus? All of it has a potential for lifting inflation. So from the Fed's perspective, they really don't want to cut here. And I think the message is please don't expect a cut anytime soon from us here, because the last thing they want to do is have to hike rates or try to hike rates later on in the year if they feel like they've overdone it. So I think they'd really like to wait a while here before making their next move.
Stephanie,
hey, Brian,
go ahead. Yes, go ahead.
I just wanted to add something very quickly to that, which is that I think the Trump administration is going to suffer a little bit from the lessons learned in the Biden administration. I think if you ask your average Fed official, they'd say, maybe we should have responded a little more forcefully and changed course perhaps a little more quickly when it came to the stimulus from the Biden administration. So I think they'll be a little bit more on their toes about fiscal policy. Now, some of the Trump administration may see that as being hypocritical or however, but the Fed is really good at fighting the last war, and that's one of the wars they'll be fighting, I think, which is this idea that we need to be on our toes when fiscal policy changes.
So true. And Stephanie, I don't know if the next question will be relevant to that or not, but I was going to say, what for you is the most important data? I mean, is it still jobs report? Is it inflation, consumer confidence? Or is it just, like to Steve's point, what comes out of the White House?
Yeah, I mean, of course, what comes out of the White House is going to be quite important. Granted, we might not get information on that right now, which is why the Fed can't really react, and it makes sense for them to not do all that much. From a data perspective, employment cost index this week is going to be very important to gauge to what extent the labor markets are inflationary or not. Our base case is they're not that inflationary right now. But we are worried about the pace of immigration really starting to tighten the labor market. And I think this is not really widely discussed enough. If we really start to see 3.6 million visas roll off over the next 2 years, that's likely to tighten the labor market pretty substantially. And it's going to make the job for the Fed quite difficult.
Yeah, and I think, Jim, listen, ultimately we can get into these theoretical discussions because we don't know what's going to happen. But I do know this, is that a lot of our viewers and listeners care about what happens to their 401ks, their 529s, their Roth and other IRAs and their stock funds and whatever it may be. The bond market has kind of done its own thing, right? It's raised rates even as the Fed has cut rates. So what do you and your team at Morgan Stanley see with rates and equities and bonds going forward?
So it's a really good question because effectively monetary policy is no longer the only game in town. Fiscal policy is going to play a major role. This is something that we all have to digest, we all have to take on board, and we all have to incorporate into our investment decision-making process. What the Trump administration is trying to do is have easier fiscal policy, taxes, deregulation, things like that, to generate growth and also keep inflation low. Those three things don't often hang together. So essentially what the Trump administration is trying to do is through deregulation move some of the activity, business activity, more to the mid-cap sector. So we still like the equity markets. We still think equities are a good investment, but we think it's true in the broader markets, more in the mid-cap sectors, where some of the deregulation and fiscal growth policies might have the biggest impact. On bonds, we're relatively neutral. We don't think there's going to be a recession, so we think default risks stay relatively low. We think you're going to get the coupon in bonds, but I don't think much more than that. So essentially, it's really a balanced portfolio. But if you ask me, I'm a little bit more optimistic on the outcomes here, and I want to entertain the possibility of an upside. So I'm a little bit more positive on the equity side. However, it's more in the broader markets, cyclicals, materials, industrials, things of that nature. The mid-cap sectors more so than just large-cap tech.
I haven't heard so much excitement for mid-caps. I mean, maybe ever. But David, I was going to turn to you also as a wearing your strategist hat. What are the real-world investing implications?
Well, I think it's not about the economy. It really isn't. The economy is fine in terms of growth and jobs and profits and inflation. The real issue is that we've got some bubbly valuations here. We've got markets which are very concentrated. We've got portfolios which have drifted to be very concentrated. I mean, a lot of people have a portfolio which is much riskier than it was 5 years ago. And meanwhile, we've got the potential for some of these administration policies to disrupt things. So I think people should really just don't look at the economy. Look at how you're positioned. Are you basically in too risky a portfolio, all said, for the world of uncertainty that we have right now?
I like risk.
Hey guys,
David. It's the only way to make money. Go ahead, Steve.
Far be it for me to steal Rick's thunder. I don't know if you have Rick coming up, but it looks like yields are a touch higher. And I'll give Brian the bingo award there, seeing this as a little bit hawkish. I think that's the way the bond market, I'm trying to get a beat on the probabilities. It still looks like there's an odds-on probability of that second cut in December, which is the thing that's been up and down, but just something worth watching. I got about 5 bips on the 10 and maybe 4 or 5 on the 2 year as well. So it does look like the market is digesting this. Is just a bit hawkish.
Yeah, it's because the statement, Steve, they removed the cooling of labor and the lack of improvement on inflation. So.
Right, exactly.
Yeah, they sort of see those ticks moving, I guess, against them. All right, everybody, let's leave it there for right now. Let's get out to Rick for some more reaction in the bond market. We appreciate it. Steve, Stephanie, Jim, Karen, David, Kelly as well. Rick, you see this kind of backup in rates. When we say hawkish, it's so interesting to sit here at 2:11 Eastern, and a 5 basis point backup in rates can easily become a bloodbath, or we can just end up shaking it off in a couple of hours. Which way do you think this one goes?
Well, I think I would consider it much more serious, and it's not how many basis points that we're going up. In my opinion, it's where we have been holding. We've been holding 4.5%. We've been holding 4 3/4 in a 30-year. And there's a lot more going on under the hood. Let's look at an intraday of twos. Okay, you can see what it's doing. Rates are moving up. But when you hook it into yesterday, what this did was this put today's yields above yesterday's high yield. There's twos. Now look at 10s. Same dynamic. Look at a 1 day, look at a 2 day. Look at 30s. Look at a 1 day, look at a 2 day. This is significant. The dollar index, as you see, had already traded above its previous day's highs. You know, what we are going through right now is, and I'm not sure what I like better when I reference it. Are we in uncertainty pricing or are we in disruptive pricing? Take your choice. And in either case, CNBC loves disruption. We have disruptor conferences. But it seems as though this administration, disrupting is a negative thing. It's viewed as negative. And when you look at the notion that everybody seems to bring forth is that all you need to do is change our target from 2% to 2.5% or 2 3/4 or 3%. It doesn't make a difference. I couldn't agree with any statements more than that. With the debt and deficit issues we have, with the disruptive pricing that we have, should they move the goalposts, you know what's going to happen, in my opinion? The market will penalize them via much higher interest rates. It's a bad idea. Yeah. And we could talk about it and talk about it, but in the end, if they actually do it or a senior Fed official actually voices it, my word would be buckle up.
Well, the market's already moving, and yields are indeed moving up. They are moving higher. I think it was Alan Greenspan, Rick, that said, if you understand what I said, I must have misspoke. Rick, thank you very much. All right, Bob Pisani, I hope our Fed panel is gone, because I'm going to say something really just inappropriate here. Just if you're listening on the radio, turn the volume down. You don't want to hear this. Which is that, Bob, I feel like NVIDIA right now, like the Fed, we know they're kind of on hold. NVIDIA's not on hold. NVIDIA's down, what, 5-6%? There's a lot of fears around stuff. So we're not only watching the Fed, and I think the press conference is very important coming up, but there's a lot of other stuff happening under the hood that has nothing to do with the Fed that I think is equally, if not more so important right now.
Including the big rotation we're seeing today. I mean, before this, there was more stocks up than down, and I agree there's obviously some money coming out of NVIDIA. I just want to point out that up until a minute or so ago, the reaction to the stock end of this was very, very modest, because I agree with Steve's point. The fact that they left out this sentence, inflation has made progress toward the committee's 2% objective, does strike me as somewhat on the hawkish side. And remember, what you want here, and I think David said this earlier, you want the meeting to be boring, and boring would be Powell insisting that they are moving towards the 2% objective. And any suggestion that there's not going to be any rate cuts, 1 or 2, or that there might even be a rate hike, that's certainly not in the market. So there's your big risk right now. The other risk, of course, is Powell could get dragged into some long discussion about tariffs and what I call the swamp of tariffs with Powell, and that might introduce, of course, the probability or the possibility of some kind of accidental volatility, as I like to call it. So there's your two risks right now. Other than that, the handoff for February from the stock perspective is terrific. We have 3% GDP growth. We've got, what, 20% of the earnings coming in? They're all better than expected. Very high levels of beats that are out there. We are seeing a terrific rotation in January. Cyclical stocks like industrial and materials are outperforming. Healthcare is outperforming. Even energy and financials are outperforming. Tech is underperforming. There it is. How many years have we been waiting for this story and it hasn't happened for more than a few days? Now we're on the verge of an entire month with the S&P up 2.5%, led by cyclicals and defensive stocks. That's about as good as it gets. And finally, I just want to point out, January's positive. What are we up 2.5% so far, Brian, on the month? So, you know, the old saying, as goes January, so goes the year. There we are, 2.5%. So Powell's going to get asked a lot about the fact that he left out this sentence, and there's where it's going to get very, very tricky right now.
And I think the September rate cut, the big half-point cut that kind of was a howitzer it's a World War II artillery reference. The howitzer, I think, I hope will get more questions. Bob Pisani, thank you very much. Well, folks, we are just moments away from that press conference. Well, maybe we'll get questions on all of this, right? What happened to that reference to inflation? Was the rate cut in September really necessary? Why is the bond market moving this way? Why am I asking so many rhetorical questions heading into a commercial break on television? There's so many questions.
It's called a tease.
It's called a tease. I hope it was good. We're back right after this.
We explore the intersection of innovation, investment, leadership and sustainability in sport.
It's good to try to be sustainable. It's all about technology in the end.
From sailing,
the athletes have to act sustainably at events, and they have to really focus on what are they doing to give back.
to an ancient martial art.
This experience is a new experience. You can think of it as a new discipline. Because of no physical contact, we can fight regardless of the age or gender.
Or in the next CNBC Converge.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Frank Holland, Worldwide Exchange, CNBC.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Our Power Lunch Fed Day special, and we are seeing some market moves this hour, in part because of what the Fed just announced. It wasn't the actual decision. It was to some extent the fact they took some language out a little bit hawkish. Dow's at a session low. We also have NVIDIA, a big mover this afternoon on reports the administration may tighten curbs on its sales to China. The company now saying they're ready to work with them on AI. Let's bring in Dom Chu for more. Dom, to help kind of round up what's driving what here.
Yeah, so let's start with those NVIDIA shares on that recent roller coaster ride, and it just continues. Shares of the chip giant are just about session lows right now. As you can see, they're off by about 6.5%. That yellow line, by the way, is the 200-day moving average. As you can see, we're just right now below it, so it represents one of those key chart levels some traders are watching. All of that, as you point out on this Bloomberg report, citing people familiar that the administration has discussed potential tightening of sales curves for NVIDIA products to China. But did, though, say the report that the conversations are very preliminary, but it was enough to exacerbate an already down day. The general story in the chips trades does still remain mixed today. As you can see there, Broadcom, Taiwan Semi are down, while you see some gains in Intel and AMD. ASML Holding, though, continuing solid gains following a better-than-expected quarterly report and better-than-expected reads on future orders. And let's count things off with a check on the three of the Magnificent Seven that are actually reporting earnings today. Microsoft, Meta Platforms, Tesla, each you can see there just about lower to marginally lower. Each of them reports after the bell. The options, by the way, market is currently pricing in what could be a 4% up or down move in Microsoft on the heels of that report, a 7% move in shares of Meta Platforms, and a 9% move in shares of Tesla. So we could be seeing some possible fireworks, Brian Kelly, for some of these reports. Tesla's going to be a notable one to watch after the bell. I'll send things over to you.
Yeah, and interest rates, as you said, Dom, also move these high valuation and high multiple stocks. So if the Fed moves interest rates may move those stocks, which then are big enough to move the whole market. I don't know about Europe. My brain is exploding just thinking about it. Dom Chus, thank you very much. As we noted, folks, Dom's brain never explodes. It's so big. All right, we are just moments away from Jerome Powell's press conference. There's an empty lectern. That lectern is not saying anything. But when a human being walks into it, he's going to say a lot. Watch out. Watch out. We're back right after this.
CNBC. Live ambitiously.
In addition to hedge funds and registered advisors, Interactive Brokers also serves individual investors. We give you all the tools and technology we built for our institutional clients for free. Let Interactive Brokers assist you with your market goals. The best informed investors choose Interactive Brokers.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
I started investing a little money for my dad, and I got bitten by the bug. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Welcome back. Just a couple minutes away from Fed Chair Powell's press conference to explain what turns out to be kind of a hawkish statement top of the hour. They didn't cut rates, but let's talk to Claudia Sahm about what they did do. She's New Century Advisors chief economist, creator of the Sahm Rule, a member of our mock Fed panel. Hope you're feeling well, Claudia. It's great to have you here today, especially. Are people reading too much into the statement, do you think?
Yeah, we got to be real careful today not to make news out of what is not news. Right? Like coming into this, we knew what's left, inflation. Like that's what's left. That we got good news on the labor market, things have gotten better, and all the Fed is doing is telling us that's where we're headed. So I don't think the statement, the very small changes made to the statement should come as a surprise or tell us something we didn't already know. Like inflation is still somewhat elevated.
So, you know, you're talking to a trading desk right now, and it's you know, it's like we're pounding stocks lower, we're sending rates higher. This is going to craft the narrative for the next 6 weeks. What do you want them to be thinking about?
Again, I think it's important in the press conference to take a deep breath. Right. The Fed, the actions of the Fed, and this has been true for some time, and it will absolutely be true for this year, it is driven by the data. We do not have the data that will decide when the next Fed cut is. We just don't. And Powell doesn't have it, and he's not going to give it. So trying to infer that from what he says is just noise. So we just really need to be careful about, you know, we want to hear that information, but that just is not known yet. So be careful.
Yeah, Claudia, it's Brian Sullivan. Here's the problem I think the Federal Reserve has, as somebody who has gone across this great land talking to people. The Fed has no control over a lot of the inflation that we actually feel. I mean, they can't do anything about automobile insurance rates. They can't do anything about home insurance rates. I doubt they can do anything about health insurance or health care costs, right? We know that eggs are soaring because of avian flu. You get my point, is that we could have inflation data that comes in red hot, and what the heck is the Fed going to do about anything that I just referenced?
Well, they do have levers to pull on demand. I mean, that's how interest rates work, keeping them high. So they can look at the sum total of inflation, but you're absolutely right. We've had some very specific kinds of cost push inflation. So eggs are a great example of this, where the Fed does not have the precision to go at the root cause of that. And yet they can look at overall, like, is demand outpacing supply, and are we overheating? And I mean, we don't see that, right? Like the last mile of inflation does not look like that. But you know, they don't have the magic wand, but they do have the mandate, and they have to keep, whether or not it's the kind of inflation that they can fight really well, they have to keep at it until inflation comes down. So that means interest rates stay elevated.
Do you think the risk this year, Claudia, is more to the inflationary side or the contractionary side? Granted, maybe it can be both.
I think there's so much policy uncertainty within the fiscal and the trade policy space. And honestly, you could see it go in a lot of different directions with growth effects or with inflationary effects. I think inflation, if you're really interested in like, what's the path of interest rates? What's the Fed going to do? They're going to be just intensely focused on what happens with inflation. So those are risks that, like, in a Fed space, but more broadly in the economy, I think we just have a lot of unknowns in terms of what the economic policy outside of the Fed is going to look like this year. And while it won't necessarily be the bottom falls out, it's so dramatic, it can still be disruptive. And we're tired. We've had a long disruptive period. So to have more of that facing us is just, it's kind of a dispiriting way to start the year.
Yeah. Well, if the chair feels the way you feel, we'd expect him to kind of push against this and to use the market language, almost be dovish. But he tends to kind of reinforce the statement message, Claudia. And sometimes I think he likes to upset markets, frankly, sometimes.
I don't think he comes out to make big reactions. And frankly, today, like, trying to keep things as calm as possible and stay away from some fairly politically charged topics, which I'm sure he'll be getting about Trump administration policy and Fed independence. So I mean, like, I think today will be, you know, try and play it cool. But he does need to. The Fed, when Powell speaks, he speaks for the Federal Open Market Committee. So, you know, he needs to convey the concerns that come from the committee. And, you know, again, at this point, with where the data is, where the economy is, being concerned about inflation first and foremost, like that, I mean, that's inappropriate. And that's what I imagine we'll hear from him.
What you just said is so, well, there, you know what? We'll save it for the next segment. It's going to be really important. Here's Jay Powell.
Good afternoon. my colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact. Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to 2 good readings or 2 bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret too good or too bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder. And meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin. But we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed, in general, wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, Throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are, this is what we do. We study the data, we analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do, that's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. It'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case, but you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, key example, is that you now do see owner's equivalent rent and, housing services, the way it's calculated for PCE. You see that coming down pretty steadily now. And that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seen to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things. And you put your finger, though, on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But yeah, I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half year.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So if those 2 things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say, so I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Andrew.
Thanks, Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course. As I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know. And, again, the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that the rates do appear to be abundant. As always, we stand ready to take appropriate action to support the smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So. We control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And a separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
You know, I want to avoid commenting even indirectly on the conduct of tariffs. You know, it's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, you know, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But you know, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level. Because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
You know, we hear anecdotal reports, but I don't see, there's nothing in the data yet on that, but you hear that kind of thing about construction, for example, and you know, businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But again, I know you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. You know, the possibility. We think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, you know, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? You know, that was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid. Downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
You know, it's one of those things we'll know it when we see it, but more the expectation is that we will make continued progress. And, you know, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Chair Powell, Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it, if I'm being at all unclear. We're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, we said what we said was that, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities. And that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal, just because of excess risk aversion may be related to regulation and supervision. So,
and with respect to households and their inclusion in asset plans?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have the securities laws that we have. It's why if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
That That was Chair Powell following the very first Fed meeting of 2025, one in which there was no change in interest rates as expected, but there was plenty said in the news conference we just watched. Chair Powell saying, among other things, inflation remains, quote, somewhat elevated relative to the Fed's 2% target. He said conditions in the labor market are solid. The economy is strong overall. He did point to resilient consumer spending. Still considering additional adjustments, he said, quote, we do not need to be in a hurry. You probably heard as well our Steve Leisman asking the very first question about President Trump's recent address to leaders in Davos, in which he said he would demand that interest rates drop. Chair Powell wouldn't address that at all, said he has had no direct contact with the president. Welcome to Closing Bell with that. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. We're showing you the markets here because in this final stretch, the major averages are lower and did move that way when the statement was released, perhaps came a little bit off the worst levels of the session, albeit slightly. Bond yields, they ticked up a little, especially the 2-year, perhaps on the comment about inflation remaining a bit elevated. The dollar worth noting, too, because it's also, at least was, near session highs, although it's come off of that boil just a little bit as well. As we always do, let's welcome in Double Line Capital CEO, CIO, and founder Jeffrey Gundlach. It is a CNBC exclusive. Welcome back. It's nice to see you in this new year.
Yeah, good to see you, Scott. Nice to be here again.
You said on social media leading in that this was the most predictable, quote, no change in years meeting. What do you make, though, of what you heard? The market seems to have taken this at least a bit hawkish. Is that your takeaway as well?
Yeah, it's a little on the hawkish side, I think. I mean, the words of this press conference are, you actually nailed it in your intro, Scott. It's no hurry. We're not in any hurry to cut rates. And that's appropriate, I think. We've had a range-bound interest rate market for some time now, and the 2-year Treasury is about 4.25% or 4.2%, and the Fed funds rate is at 4 3/8, so they're very much in sync. So I heard a very wide-open view of what the next move might be. No hurry to cut rates. Doesn't seem to be there's any inclination to raise rates at this point in time. And he's obviously focused on the stability in the unemployment rate right now in terms of not feeling a need to cut rates. The inflation rate has been drifting higher by a little bit. I mean, the CPI is up in the high 2s, and it was down in the mid 2s. And with the commodity complex being above its 200-day moving average on the Bloomberg Commodity Index, and looks like it may have bottomed out, and the price of oil is in the low 70s, and Trump wants to get the price of oil down, so he says, drill baby drill, but the price of oil hasn't changed very much. It's still somewhat elevated. So what's really fascinating is since the first Fed rate cut back in September, the 2-year Treasury yield is up by 60 basis points. The 10-year Treasury yield is up by 85 basis points. The long bond ETF is down on price only, forgetting about the coupon. It's down by about 11%. So we have had this very unusual move that with the Fed beginning a cutting cycle, we have not seen a bond rally. In fact, the general high-quality bond market hasn't made much progress. So I think no hurry, and we're very, very data dependent. It seems like a new high has been reached in data dependency. And I worry a little bit, as I have periodically since the hiking cycle started and now the cutting cycle. I worry that we're running into a high degree of short-termism, that we're going to wait and see what the data does in just a few months ahead is what I think we're looking at. But I think market participants' takeaway from this is the Fed is on hold, and they're just going to wait for data. And so what came out of this meeting was completely expected, and not a lot of insight on where we're headed other than data dependency.
I feel like we might have gotten some insight, if nothing else, into the psyche of the Fed chair when he said policy is, quote, well positioned. I mean, I think he made the case that they think they're in a really good place and they can afford to not be in a hurry, as he said. You agree with that, or do you call that into a little bit of question?
I think when he says we're in a really good place in terms of policy and the economy, he's basically saying we're on hold.
And yet, contradicting that, he says we're above the neutral rate. So the implication is that we're on hold until the inflation rate goes down. And unfortunately, it's probably not going to go down very much in the several months ahead. So I wouldn't be looking for rate cuts at the next meeting. Certainly we didn't expect one in this meeting. And so we have a relatively stable place where we're standing. And it kind of supports the fact that the market is in a calm position right now, and so is Jay Powell, apparently. There are some things that are troubling, though, regarding markets. I notice how high the CAPE ratio is on the S&P 500. It's up in the mid-30s. It's interesting that when Ronald Reagan took office, the CAPE ratio was down at about 10. And so now it's about 4 times higher, or 8 times higher anyway, than it was when Reagan took office. So it doesn't seem there's any room for valuations to expand. And so it's an entirely earnings-driven market. We're going to have to see how that develops. At the same time, the credit markets are very, very low incremental yield versus treasuries. This has been a theme that's been developing now for a year and a half. And there's not a lot of room for error. And in fact, some things have happened, if you get a little bit down in the weeds, that are somewhat disconcerting, because they're reminiscent of what was going on in the mid-00s heading into the global financial crisis about 20 years ago. And that is that we're starting to see retranching of credit risk. You remember it was the credit ratings that screwed everything up in the subprime market back in 2007 or so. Well, now we're starting to see in the resecuritization markets of bank loans, which is called the CLO market, what we're starting to see is retranching of traditional letter ratings. So for example, there's triple B rated bonds, and all of a sudden they're retranching them into senior triple Bs and junior triple Bs. Why are they doing that? They're doing that because the average interest rate that's paid by tranching it into 2 pieces is lower than the interest rate if it was just a triple B. And this is a slippery slope. It's only getting started now. I don't think that it's an imminent problem. One thing I've learned in over 40 years of the investment business is you might be seeing signs that are worth taking note of, but by the time that they really develop into a consequence, it takes much longer than you think. So in the subprime crisis, the retranching stuff and the nutty activity got started in 05 and into 06, but it wasn't until 07 that it really blew up. So I'm not really looking for this to be a problem in the first half of 2025. It's something that bears watching, because once you start making AAA rated securities out of triple B rated securities, which is what actually happened in the subprime nuttiness, that's not happening right now, but it is a slippery slope, something to watch out for. So we're getting more and more concerned about the levels of valuation on the lower tiers of credit. I've talked about this in the past Fed meeting day appearances, but it's getting worse. It's getting more overvalued, and there's these activities of retranching are they're dangerous over a multi-quarter time frame. So I think investors need to be upgrading across the board in terms of reducing risk and upgrading across the board based on valuation. And the Fed's on hold, and they're not really in any hurry, as Jay Powell said, to cut. So you're not going to get any relief from interest rates, and you're not going to get any relief from valuation, because valuations on stocks are very, very high versus their own history, and the valuations on non-treasury bonds versus treasury bonds are very, very high based on their own internal history. So this is a time to be careful.
Did think it was interesting that when the chair was asked about financial conditions related to the stock market, he said that asset prices are elevated by many metrics right now. Now, he was, and I think he made the point pretty clearly, that he was zeroed in on parts of tech and the AI related stuff, but maybe not overall. So I understand what you're saying. Last time you were on with me, you said, quote, 2 cuts are on the maximum side for 2025. Given the fact that you believe today was, maybe putting in Sharpie, if you will, that they're on hold for the foreseeable future, 2 cuts, does that still make sense to you for the balance of 2025?
I would say exactly what I said in December, and that is maximum 2 cuts this year. And when I mean maximum, I'm not predicting 2 cuts. I just think that's the most you can possibly think about. And at the present moment, if you had made me pick a number, I would say now 1 cut would be the base case, and maximum 2, though, still.
Isn't that pretty good? I mean, wouldn't that be a good thing if the Fed doesn't have to cut as much as it might have thought initially, and that investors have come to grips with that fact? As Chair Powell said, as I told you what he said about, where the economy is and the labor market, he thinks they're in pretty good balance right now.
Yeah, well, the unemployment rate went up for consecutive months, several months. It went up, and now it ticked down. And I think in the most recent reading, and I think he's taking a lot of solace from that movement. He was worried about the labor market weakening, and so the Fed's goals were in something of a tension. I mean, the CPI, or the year-over-year inflation rate, which he referenced today, that you use year-over-year. I thought that was important. He mentioned that it takes out some of the noise of seasonality. But it's a departure from where we were 18 months ago when we were talking about annualizing short-term inflation numbers. So he's looking more at year-over-year inflation. I do think that the unemployment rate being at 4.1 and having relaxed a little bit, I think that unless the unemployment rate starts going up, there's going to be it's going to be a slow process to get to a hurdle to cut rates again. And as I said just a few minutes ago, I don't think that you're going to see a cut at the next Fed meeting. So when the Fed says we're in a good place, it means the policy, he believes, or he chooses to believe, that it's going to lead to the unemployment rate staying at a comfortable level, a relatively low level, and the inflation rate, he's hoping that it comes down. I don't really understand. They mention owner's equivalent rent or the shelter component, and yes, that should come down. I don't know how much Southern California is going to factor into that because there's obviously not going to be home price declines for new construction or for rentals and so forth in Southern California. But I think it is good that the Fed's on hold, and it's because you need the Fed to be on hold or being easing to support the valuation levels that we have.
Steve Leisman's come out of the room. Jeffrey, bear with me for a moment as I bring him into our conversation as well. Well, you tried, number one, to get him to react to President Trump, as I thought you might. But let's move to...
There's a time, Scott, when you've got to fall on your sword. I just did that for the entire press group.
What do you make of the market's initial reaction, Steve, to what was thought to be a smidge more hawkish by the chair and the statement, which I think you acknowledged immediately thereafter? Now, the market is coming back a little bit as well. Do we have it right?
I'm so glad you asked that, Scott, because I have a pet peeve I want to get off my chest here, which is this. Why does the Fed do something in the statement that needs to be later clarified in the press conference, okay? What exactly happened, what you're talking about, Scott, if you look at the 2-year shot up because what happened is they took out that statement that we'd made progress on inflation. Powell then comes to the dais and he says, that's not really a big deal. We're just cleaning up the language. Market rallied again on that. Yields fell. You can even look at the stock market. It was spooked by that and then came back. Of course, there was also the added positivity or positive comments that happened on the employment front as well. I think Jeff and you have zeroed in on a really important question, and it was important for Powell to say that we are meaningfully restrictive, and let's listen to what he said there.
I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is, but not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
So that's kind of the answer to the question there, which is why do they stand pat? Because they've already cut 100, has to work its way through the system. And then I do believe, as Jeff suggested, he took March directly off the table. You look at the probabilities right now, we're at just 22%. That's fallen. You can see we're below 50% on May. And then there's the two cuts that look to be priced in, a June and a December one, but it's not like there is overwhelming conviction on really either of those, especially that second cut in December. So, and that gets Scott to what you know already, which is all of this uncertainty about fiscal policy. He basically said, we're on hold till we know what the heck's going on here.
Yeah, he did. Well, you're just on hold waiting to see that it's hard to make assumptions is what the chair said. Steve, thank you very much. That's Steve Leisman, just out of the room. Got the first question today to the Fed chair as well. Jeffrey, I'll bring you back in. in terms of inflation, it was the chair who said, quote, we seem to be set up for further progress. And in fact, recent reads on inflation were more calming. I think we could agree. Do you think we've seen the peak in the backup in rates that we witnessed from the cut that we sat together on, the very first one, that jumbo cut, then rates backed up. We both sort of looked at the screen and were like, whoa, that's interesting. And they continued their march, certainly the 10-year towards 5%. It felt like it was going to get there, but then they backed off of late. Had rates peaked?
I think that rates have not peaked on the long end. I think rates will have another move up on the long end. It is interesting that the chair says, that we've cut rates by 100 basis points, and that's true on the Fed funds rate. But the 10-year Treasury rate is up by 80 basis points since that first cut. So mortgage rates, which price off the 10-year Treasury, had relaxed a little bit, and so housing got a little bit of improvement. But rates are back up to about 7% on 30-year mortgages. And I think the longer they stay at that level, the shock of, people remember the 3% mortgage rates, and then all of a sudden they were 7, and that's kind of a shock. But now they've been up at 7 for around 7 for really a year and a half. And so, but I think that the budget deficit problem is primarily responsible, I think, for this backup in long rates, even though the Fed's cutting interest rates. This is by far the worst performance of the 10-year during a Fed cutting cycle. Usually bonds rally when the Fed starts cutting rates, but that didn't happen at all. In fact, rates went up. So I think that inflation is not going to easily go back down to 2%. We're well above 2%. I mean, we're at 2.9 on the core CPI, and or 2.6 or 2.7 on the headline. I mean, we got to get below 2.5, I think, to talk about putting rate cuts back on the table. And Chair Powell was quite clear in stating that we don't need to see a 2.00 inflation number, and I think he uses the PCE primarily, but we don't need to see 2% to talk about cutting rates. It's almost like it's the direction of the CPI, and right now the direction of CPI is sideways, and he needs it to start coming down. I see that the owner's equivalent rent can filter through. There is merit to that idea, but I don't really see it from the commodity complex. And we'll see what happens with tariffs. So there's a lot of uncertainty, and for that reason, I think we're only 6 days or 8 days, whatever it is, into the administration. For that reason, I think the Fed being on hold, corroborating the, with the Fed funds rate totally corroborated by the 2-year Treasury, it's appropriate the Fed's on hold, and so this was a inconsequential meeting versus expectations, a little bit of hawkishness with that no hurry language, but he was a good three-handed economist, on the one hand, on the other hand, on the other hand, and it's a wait-and-see situation.
Given your view of the deficit and certainly the longer end of the yield curve, is that why is it a fact that you still like intermediate dated bonds, nothing longer than the 10-year like you told me before?
Yeah, we still believe that the yield curve continues to steepen. Irregularly, of course, but we were negative 108. The 2-year Treasury was 108 basis points above the 10-year back in last summer, and now it's at 34 basis points positive. We've had a huge swing on that, and I think it has a lot to do with supply problems, and I don't believe that the deficit is going to improve under the Trump administration. You can find, $50 million here and $6 million there through something called, the Doge thing, or the dog E as I call it, but I don't think you're with looking at some tax cuts and forever spending on wars and natural disasters and all this stuff. I don't think the deficit's going to go down under Trump, and that's going to be a problem with the Fed on hold, and now the bonds that were rolling off from 5 years ago with coupons of 0.5% or 1%, it looks like they're going to be solidly in the 4.25% to maybe 5.25% range when those bonds roll over, and there's a lot of them coming up. So the long end, I would continue to avoid it. I like the intermediate part of the market. It's not nearly as attractive as it was 18 months ago. Spreads are much tighter on credit products. The Treasury rates are lower than 18 months ago. But when you take a look at the inflation rate, even if it's at 2.5% to 3%, you have a real rate of return from fixed income. I think you should always have a real rate of return from fixed income. We've lived through so many years of repression of interest rates that we had zero or negative interest rates versus the inflation rate for a long time, we should always have a term premium in bonds, and we have one now. So bonds aren't all that risky, but I do think that under the fiscal situation that we'll likely see another move up in the 10-year Treasury yield.
Everybody, obviously, you, me, every investor, the Fed chair himself, as he made it clear today, trying to figure out what the impact on the economy and inflation tariffs are going to have. The proposed Commerce Secretary, Jeffrey, Howard Lutnick, said today on Capitol Hill that it's, quote, nonsense that tariffs are inflationary. What do you think?
Well, he's got an example to point to. It's a sample set of one, but the last time the tariffs came through, we did not have an inflation problem. Back under the first Trump administration, there were tariffs, and inflation did not stir whatsoever. So I'm open-minded on the idea that tariffs do not have to have an inflationary impact. But first, we have to see what the tariffs are going to look like. And there's an awful lot of saber rattling going on with the tariffs. If you do something that the president doesn't like, it's instantly tariff talk. And I don't know, I don't think that's really healthy as a one-tool reaction to all policy programs. You know, if you have a hammer, every problem looks like a nail. And if you're a tariff guy and you're going to respond to policies of foreign countries that you don't like and you're just constantly going to tariffs, I don't know. I think the effect of that will incrementally wear off. But we'll wait and see what the tariffs look like, and they need not be inflationary.
You have argued against the renewal of the tax cuts. I've asked you about that on several occasions. You've been pretty unwavering on that. Is that still your view today?
Yes, I want the budget deficit to shrink, and you're not going to do that by more tax cuts. So I don't really like the SALT thing in the tax cuts. I think it's really kind of absurd that was put on way back in the first Trump administration. That one I'd like to see go away, but otherwise the tax cuts, I don't want to see tax cuts. I want to see spending cuts. And I don't know if we're going to get that. Certainly history has not given you confidence that talk of reducing spending was going to result in a reality of cutting spending. But we shall see. Trump was a deficit spender in his first term, and I don't see any indications that that's going to change. And that's why I caution against high-risk positions right now, because I think long-term interest rates can go up, and valuations, as I said at the outset, are very high on credit in the bond market and on, obviously, parts of the equity market. So I'm favoring, again, equal-weighted equity exposure rather than market-weighted. That seems to have started to work. And I think fading the trends of growth versus value and small cap versus large cap, equal weighted versus market weighted, I think those got very extended during 2024, and I would not want to be betting on just a momentum trade that continues. So I like equal weighted in the S&P. I continue to like cash because Fed's not going to cut rates. Bonds on the shorter end to intermediate range, the price off of Fed on hold will continue to deliver. You can get 6% fairly easily. It's not going to make you rich, but it's a real rate of return of more than 3%. And I think you can live to fight another day when you get cheaper valuations in both stocks and credit bonds.
On that note, has what I like to refer to as the Gundlach model portfolio changed in any way? You like cash. You said last time 30% cash, 50% short-term bonds, 20% in U.S. stocks. That still sound right given what we know today?
That's about right. I might change something, in 05 here or there, but broadly speaking, that's the right parameter. About half money in relatively, middle credit to upper credit bonds in the shorter, to the 5-year area, 3-year area of the yield curve. I don't like stocks at these valuations, and I would still maintain maybe some of that cash you might want to hold in a real asset, perhaps a commodity fund, which seems to be showing signs of life. And gold, I think, has another move high as well, although it is near the all-time highs. But I still think dollar cost averaging into gold makes sense in this uncertain geopolitical environment.
Sure. Before I let you go, Jeffrey, I know, and you know, we've talked before, and I could see from some of your social media posts that you're out in the Palisades, and it's really hard to comprehend those pictures, especially 3,000 miles away here in New York for many. I just wanted to say we wish you well. Everybody out there, our hearts with everybody. Just a terrible situation that's going to take a long time to recover from.
It's much worse than anybody realizes in terms of the disorganization. There's nobody in charge. There was no preparation. And nobody knows what rebuilding is supposed to look like or how it's going to be organized. But I was spared. I was evacuated for 3 weeks, but I was able to get back this week. And I had some damage to my property, but fortunately my house inside is completely intact. If you go through the neighborhood, it truly does look like the pictures you saw of Dresden from World War II. And all that's left in most houses is a bunch of powder on the ground and a chimney. And the chimneys are evocative of a tombstone. And there's an awful lot of them, thousands and thousands of them. It's absolutely brutal to go through the neighborhood. And it's not going to be a short period of time. It's going to be years and years before this gets to some level of stability and livability. So thank you for the thoughts, and lots of people dislocated. I've had quite a few employees have their houses burned to the ground.
Yeah, it's hard to process all of it. We wish you and everybody well. We'll see you next time, Jeffrey. Thank you.
Okay, thanks, Judge. See you next time. Good luck, everybody.
You bet. Yeah, that's Jeffrey Gundlach. Up next, some big events in overtime tonight, including, Meta and Microsoft. They report at the top of the hour. We'll run you up to that next.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Learn how to use AI to be more successful with CNBC Make It's new online course.
We'll give you examples that can help you master AI tools.
Special offer ends February 11th. Go to CNBCMakeIt.com/AI and register now.
Diane von Furstenberg's name is synonymous with the wrap dress. This iconic piece of fashion made its debut in 1974 and was an immediate sensation, with 1 million of them being sold in just 2 years. 50 years later, the wrap dress is still a bestseller and a wardrobe staple seen on everyone from royalty to celebrities.
I created the dress, but truly, the dress created me. So why? Well, first of all, the fabric. The fabric was this jersey that molded the body. Then it was the prints. They always move. It changes your body language. And so the more people notice it, the more happy you are with yourself. Somebody said something very funny once. It's the dress that you get the man in and his mother doesn't mind. So it's both sexy and proper at the same time.
CNBC Tech The Edge explores the aerospace industry's use of hydrogen.
Here is the cockpit of the first hydrogen airplane, which is attempting to fly non-stop around the world with 0 emissions.
So let's talk about the aircraft itself. What are some of the key things in the aircraft's research and development and design?
All the structure has to be really light, really strong, but it's not only a plane, it's a propulsion system. And to imagine the complexity, hydrogen has to be kept in the liquid form at a temperature of minus 253 Celsius, almost the absolute zero. So the tank has to be really well insulated, and the little part of hydrogen that will always be evaporating, this is called the boil-off, and it will feed the fuel cells, run the electric motors, and allow it to be silent, to be clean, and to be really efficient.
All right, we're now in the closing bell market zone. CNBC senior markets correspondent, commentator Mike Santoli is here to break down the crucial moments of the trading day. I gave you 2 titles. You're that important.
I'll take it.
All right. Plus, 2 heavyweight hitter earnings in overtime. You know by now. Steve Kovac on what to expect from Microsoft. Julia Borson on what to expect from Meta. I'll go to you first, Michael. Your reactions to the Fed, how the market initially reacted, and then how it may be recalibrated itself for the word of the last few months.
It's funny, in the noon hour, I, of course, said, look, low drama meeting, but the market will probably find something to trade. And they did, that sort of 5-degree tweak of the language toward maybe a slightly hawkish direction. But I think the takeaway was a kind of well-earned patience that Powell feels right now. I'm not seeing tremendous risk to waiting even longer, waiting perhaps beyond March, is the way the market sees it right now, to change rates at all. And I do think it does reflect, as he frequently says, policy's in a good place. It matches up with where the economy and the markets are. We're at this kind of equilibrium point. I think it's worth reflecting on the fact that 2.5% real GDP growth, 2.5%-ish inflation, 4.1% unemployment. These are things that for most points in history you would absolutely sign up for. So you wouldn't be clamoring for some kind of change. So I think that's all to the good. Now the market, of course, is already priced for some good stuff. And we're dealing with our other issues in terms of a concentrated market dealing with a rethink of the AI trade. And so you do have more stocks down than up. We're chopping around the 6,000 mark in the S&P. No big deal there. But I do think the bond market is still sensitive to this idea that higher for longer might again create this test of whether the economy can handle and the housing market can handle rates up here. But so far, okay.
Steve Cohen yesterday talked about valuation of the market. Yeah. Fed chair today was asked about it, said valuation metrics somewhat elevated by almost any metric. Sure. Now he made the point he was like looking at tech and AI. But look, when the Fed chair says something about the valuation of markets, sit up and take note.
You do. Now, he didn't walk into that room kind of wanting and intending to make a broad comment about equity valuations, but when asked, he did observe that it's hard to ignore the fact that valuations do look elevated. It's just what reality tells you. We're going to hear from these companies today that trade at 30-ish times forward earnings of the biggest companies in the world. There's no way of saying that that's not elevated. What he did say, though, is it's nothing systemic. It doesn't seem as if financial market participants are way out on a limb or that the banks are vulnerable. So from their perspective, that's just what stock markets do. They sometimes, overshoot.
It's going to be a big evening, obviously. Meta and Microsoft and Tesla. We'll talk Microsoft first with you, Steve Kovac. What do we most need to pay attention to?
Yeah, it's going to be CapEx. DeepSeek has just raised all these new questions, Scott, about capital expenditures for artificial intelligence. A week ago, $80 billion for this fiscal year of 2025 ending in June. $80 billion sounded reasonable in order to win this AI race that we've been talking about so much. And then DeepSeek just really shook up that narrative. So I really expect on this call starting at 5:30 tonight for Nadella and his CFO, Amy Hood, to really talk about whether or not they need to continue spending. I will give them credit, though. Over the last several quarters on these calls, Scott, Nadella has said we are always gauging our demand for artificial intelligence. The demand is there. We can't meet that demand. But if we see things move the other way, we're going to be nimble, we're going to be dynamic, and pull back spending if we need to. So it's going to be on everyone's mind today, going into that call, will they give some sort of indication if that $80 billion needs to come down, and going into the back half of the calendar year, if they're still going to be accelerating these AI investments, or if they're going to be pulling back a little bit and taking a pause and really looking at the landscape here and seeing what they've learned from this DeepSeek moment in the market. By the way, Microsoft shares are still lagging behind its peers here. Started off last year really hot, but the one-year chart, when you're looking versus Apple, Meta, Amazon, and Google, those are all up double-digit percentage points in the last year. Microsoft, not so much, Scott.
The fact of the matter is, too, Steve, it's probably just too soon to know what they're going to have to do with spending. We're reacting in a matter of 48, 72 hours to this news, and they are as well.
Yeah, and it's a justifiable question, and that's why I go back to these previous comments where before, in a pre-DeepSeek era, yes, the demand was there. Yes, they thought they needed to spend this much money. Does that calculation change, or are they taking this position that It's great what DeepSeek was able to do with a more limited budget and more limited technology, but we have plans that require us to continue spending with NVIDIA and all these other hyperscalers in order to make what we want to do in this AI race happen. So yes, it's been a short amount of time, but it is the question on everyone's mind, is this spending justified? And I'm sure we'll find out in just a matter of hours here.
We will, and we'll be with you when that happens. Steve, thank you. Steve Kovac. To Julia Borston now on Meta, trying to figure out what the over-under today might be on the words open source. How many times we might hear that?
I'm sure we will hear a lot about open source and also a lot of questions about capital expenditures. Just last week, Mark Zuckerberg pre-announced up to $65 billion in CapEx this year. And of course, a lot of that is about building out AI infrastructure. And AI will, like with Microsoft, be center stage for Meta. Now, Meta shares are up 68% in the past year and up 8% in the past week. Meta has been a rare mega cap tech stock that has benefited from the surprise explosion of DeepSeek because its success is seen as validating Meta's open source approach to AI, and also because Meta is seen as a key beneficiary of AI, both in terms of its ad business and in terms of its consumer chatbot, Meta AI. So the question now is how Meta's AI investments are going to pay off this quarter. Just last week, the company guided to that $65 billion in CapEx this year, but revenue growth is expected to slow to 17% this quarter and to 14% in Q1, down from 19% last quarter. So we'll have to see whether these new AI tools, whether more monetization of Messenger and WhatsApp, and the fact that ads are coming to Threads can all help rev up growth and stop that declining revenue growth rate. Back over to you.
All right, Julia, thanks. We'll look forward to those numbers when they hit and your analysis, of course, when they do. How are you thinking about these now?
Yeah, it's fascinating. I mean, Steve mentioning how Microsoft has really decelerated and been an underperformer for the last year. But in the first year after the unveiling of ChatGPT, Microsoft got all the benefit of it. So it's much, to me, more about the sequencing of how the market is now reading how AI plays out and flows into the company's bottom lines. I could make the argument that the expectations are pretty low for Microsoft. But again, you had such a massive ramp that we've just been consolidating for a while. It's still 31 times forward earnings. I don't think it's necessarily make or break for the overall market. You can have some of these do well and some of them have more of a reset lower. And we've seen this over the last 6 months, that the market can absorb that on some level as long as they're not all down at once. So open-minded about it. I think Tesla is interesting. It's obviously got a massive meme factor involved in terms of why the stock does what it does. It's 20% off its highs. It's below where it was in November of 2021, but it's up massively since the election. So to me, that's a crapshoot in terms of how we read the long-term kind of mission and story there.
I mean, it's the first time really that Musk presumably will be on the call, and that he's going to be asked about all the hats that he is wearing now, with an additional one related to Doge and the White House and everything else that he has going on. And analysts are going to be able to ask him questions again, assuming he is on that call.
Sure. It's funny because, I mean, how many CEO roles did he have to have before, anybody got concerned about that? To me, it's more about, I wonder if he'll be asked specifically, how would deregulatory moves accelerate the robotaxi adoption, or whatever the company and the stock have been given credit for as being better positioned under the new administration? Talk about specifics and practical terms and tangible ways. Maybe that'll come through here. But again, we're trying to figure out if this market can make its way forward without that kind of concentrated leadership.
And as it relates to CapEx from the mega caps, I mean, any pullback in any way, I couldn't imagine would be viewed other than positive. We've been questioning how much these companies are willing to spend. It's the fall-on effect for the NVIDIAs of the world that you would first look at, and the others, the Broadcoms, which were negative again today, and stocks like that.
It's certainly a net loss for the hardware companies, but also, I mean, you have to wonder exactly how you make your peace with how much has already been spent, whether some of it's viewed as sunk cost, whether they're seeing diminishing returns. Everyone seems to know that ultimately you spend up until you perceive you're getting to a wall. Nobody knows where the wall is. We don't know if it's close or far. So it'll be interesting to see how they characterize that.
All right, good stuff, Mike. Thank you very much. That's Mike Santoli. Bell's going to ring us out. Red Fed Chair says no hurry. No move today, and maybe no move next time, and then we'll have to see after that. That does it for us. Big earnings coming up.
That's the end of regulation. Brinker International ringing the closing bell at the New York Stock Exchange. Willdan Group doing the honors at the NASDAQ. Stocks mostly lower in a choppy session as the Fed holds rates steady and signals potential concerns on inflation, while NVIDIA pulls back on fresh worries about export controls. Now, attention turns to one of the most important hours of earnings season. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Fort.
Yeah, buckle up for a massive afternoon of quarterly reports that could set the tone for the entire market, headlined by Microsoft, Meta, and Tesla, along with IBM, ServiceNow, and many more. A key focus on AI commentary and spending plans. We're going to have all the breaking numbers and analysis throughout the hour.
Plus, we've got a great lineup to dissect Fed Chair Powell's comments, including Apollo's Torsten Slok and former Council of Economic Advisors Chair Cecilia Rouse. But as we await the wave of earnings results, let's bring in Vital Knowledge founder Adam Crisafulli and CNBC senior markets commentator Mike Santoli. Great to have you both here to kick off this big hour. Adam, I'm going to go to you first because we finished fractionally lower across the board for all the major averages. We know yields ticked up. The attention is going to turn here to mega cap tech, but we did get a Fed that is sitting on its hands just a few short hours ago.
Yeah, so I think the Fed, they threw a wild card at 2 o'clock with the statement change, and then at 2:30, Powell kind of disavowed that change. And we got a message that's been very consistent with kind of the last couple of weeks, the last few months of Fed communications. They're happy with where growth is. They're relatively pleased with inflation. They still see disinflation happening. And it's going to be a couple more months before they move again. So the market was looking for June before this meeting, and they're still looking for June as the next meeting where they will cut. And so it was kind of a wash at the end of the day. I thought the overall Fed messaging, other than that little surprise.
Hang on. We've got Microsoft earnings out. You can see right there, shares are lower on your screen. Steve Kovac has the numbers for us. Steve.
Yeah, Morgan, these shares are lower despite beats on the top and bottom lines. We're seeing EPS come in here at $3.23. That's a healthy beat over the $3.11 the street was looking for. Revenue, a slight beat here, $69.63 billion versus the $68.78 billion expected. And Azure growth was right in line at 31%. Street was looking for 31.1%. We see shares selling off about 5% here. I'm going to keep digging in, find out what's going on, and get back to you. But those are the top and bottom lines for now. We see shares off a little more than 5%, guys.
Okay. Adam, I'm going to go back to you because I cut you off. Any thoughts here on the initial print from Microsoft?
Yeah, so, it looks like the quarter was fine. Remember, Microsoft is one of these companies where you get a lot of incremental information on the conference call, so late in a couple of hours, and that will be key, quantitatively and qualitatively, especially qualitatively, where we hear about CapEx, DeepSeek, and the relationship with OpenAI. So the quarter seems okay, but just remember there's going to be a lot more to come going forward.
Mike Santoli raises the question, these results due of what role currencies playing for multinationals. I keep bringing it up, but I'm curious how much investors are factoring that in before they hear the commentary, how much of this isn't even human beings factoring it in, and how careful we have to be about reading through on these numbers, which may or may not factor in the strong dollar versus expectations.
Yeah, I think it's much more relevant to whatever guidance we're going to hear in the call on a forward-going basis. Yes, the dollar was strong in the last quarter, but I don't think that the full effect would have necessarily played through to the results being reported right now. It has been an overhang over software to some degree, but not really evident in the stocks. So knee-jerk reaction, it wasn't exactly a blow-the-doors-off margin of victory in terms of revenue versus expectations. Maybe that's accounting for the initial setback again, as well as the fact that we do have a relatively richly priced stock where the bull story has been well known for a while.
I want to mention Tesla results are out as well. That stock down 1.5–2% initially. We are going through it. We'll bring you those numbers as soon as they're ready. Adam Crisafulli, we're not talking about the Fed as much as we used to, I guess, in a way, because they're doing what they were expected to do, but the interplay between that and what the new Trump administration seems to want and expect is certainly interesting to watch.
Yeah, absolutely. And Powell was pressed on that a lot during today's press conference about the implications of tariffs and how this will affect growth and inflation going forward. And, I think the Fed's in the same position everyone else is. We're all waiting to see. We had actually some incremental news today.
Sorry, got to interrupt you again, Adam. Tesla earnings are ready. Phil LeBeau's got them, Phil.
John, this is a miss on the top and the bottom line for the fourth quarter for Tesla. Take a look at the stock, and as it moves right now, you're seeing that earnings per share coming in at 73 cents a share, 3 cents shy of estimates of 76 cents a share. Revenue, $25.71 billion. That is below what analysts were expecting. They were expecting $27.265 billion. So again, a miss on the top and the bottom line. We're going to dig into the report, see if we can get you some of the key numbers within the numbers, including automotive gross margins excluding the zero-emission vehicle credits. Guys, we'll send it back to you.
All right, Phil LeBeau, thank you. Adam, I'm going to kick it back over to you, too. We got shares of Tesla down 5% right now. We also know expectations were arguably elevated going into this. Certainly the stock was. It's had a monster run since the election.
Yeah, absolutely. So, on the one hand, expectations on the near-term business were not too elevated. So we already got deliveries. We know the core auto business is not performing particularly well. There are very elevated expectations around the ancillary businesses. So whether it's self-driving, whether it's robotics. And so that will come on the call when we hear from Musk kind of describe those other parts of the business which aren't impacting the income statement yet. So it's not going to show up in the Q4 report. But it's all of that intangible aspect, the non-auto parts of the business. And that's really what drives the stock. So if this were just trading as an auto company, it would be a lot lower. It's the other parts that will really kind of determine how this trades over the next 24 hours.
Okay, we're still monitoring for some more earnings reports. In the meantime, Mike Santoli, I want to go back to Microsoft with you because in the release, they're talking about an AI annual run rate being achieved of $13 billion. That's up 175% year over year. And I think it's higher than expectations going into this print.
Yeah, I mean, obviously that's a nice number. It's not necessarily the major swing factor in the near term for Microsoft, but obviously this has been a market that they were there right at the beginning. And I think there's been general sense of perhaps disappointment or at least, not great enthusiasm about the rate of uptake right now for the current products, the Copilot that's out there. But there's no doubt they're positioned to capture some of this. Obviously, again, on the calls when you're going to hear a lot more about what their assumptions are in terms of the pacing of how they come to benefit and when they're going to be getting these payoffs and what they think they're getting for the expected $80 billion in incremental CapEx.
Okay, our Steve Kovac's got some more on Microsoft. Let's get to him with that, Steve.
Hey there, John. Yeah, just some more AI data in here. Of that Azure growth number that I gave you, that 31% Azure growth in the quarter, Microsoft is saying 13% of that is coming, 13% of those points were coming from artificial intelligence services. That number keeps growing most quarters in a row. It was 12% last quarter. But one thing that we can talk about why we're seeing stocks down 4% here is sequentially Azure growth overall is down a bit. It was 33% growth last quarter, and we're seeing sequential growth. Sequentially here, it's 31% for this current quarter. This was kind of expected, but also we're just seeing that slowdown seems to be rattling things here. We're also going to be listening for guidance on Azure growth. There's some expectation that further on into the year, we might see a reacceleration there. But in the meantime, not liking these Azure numbers right now. You see the shares down a little less than 4% right now, John.
All right, Steve, thanks. Mike Santoli, I know it varies from company to company, but with how rich the major indices are overall, and particularly the mega caps, how does that position some of these stocks reaction-wise? I mean, we're seeing it in Microsoft. I mean, you might argue that given the numbers that came out from Tesla, the reaction might have been a bit muted.
Yeah, arguably so. Honestly, John, I don't think we saw enough reductions in analysts' forecasts coming into the number to really lower the bar across the board. So, yes, it's going to be company by company. Yesterday, we thought it was kind of a shrug for investors on the Starbucks number and guidance. And then today, we heard from the CEO, and that stock took flight. So, very difficult to handicap in near term. But I think in aggregate, people expect good things from this market and from earnings. And so, arguably, it might be a little bit tougher to really please.
Okay, meantime, IBM earnings are out. Seema Modi's got those numbers. Seema.
John, IBM's quarterly earnings coming in 17 cents above Wall Street estimates. So a big beat fueled by artificial intelligence bookings. That's clients looking to IBM to accelerate workflows, lean on AI to bring costs down. IBM's artificial intelligence business has now grown to more than $5 billion. That's $2 billion more than last quarter. CFO Jim Kavanaugh telling CNBC, quote, DeepSeek validates their strategy that open versus a closed model is much more ubiquitous. Back to the numbers, total revenues for the quarter did come in line. Software grew double digits and now represents about 45% of total sales. Gross margins, worth noting, better than expected. Currency was a headwind. But for 2025, when you look at free cash flow, they expect that to increase to $13.5 billion. It was in the $12 billion range in 2024, and shares are responding positively, John, with shares up about 9% here in overtime.
Yes, indeed. Seema Modi, thank you. I did also speak with IBM CEO Arvind Krishna about these results. I want to bring you some of his commentary on the software business. He said software did double digits, 11%. Great performance in Red Hat, which I know you still follow in the corner of your heart. So Red Hat did 17%. And we kind of like said that, look, 23 was going to be a trough. They're going to improve to 2024, but we did even better than I think we were expecting. He also talked about the consulting business, which has been a tough go. They're operating a couple points below the market when it comes to growth. But he said the good news there is we had an outstanding signings quarter. We did $9 billion in signings in the fourth quarter. We're entering with a great book to bill. When we look at that, it kind of points to recovery will happen. But I'm not going to look at you and say recovery is going to happen in the first quarter. We also talked about those currency headwinds that Seema mentioned. He said actually currency is probably going to be more like 2.5. That's points of headwind, I think, as opposed to just 2. So it is significant. It's going to cost us a lot. That's mostly the top line. We're not looking to say that our bottom line cash flow earnings get overly impacted because we can go manage that depending on where the costs are and how we get things. Now, I also talked to Arvind about DeepSeek. And he, similar to the CFO, talked about it being a validation. He said, I think the last time I talked to you, I said, look, I think small models are going to be the winner, not just big models. And I believe that we need to drop the cost of both training and inference, I believe, to 3% of the current number, 1/30. I think DeepSeek was just a proof point of the journey that we have been on inside IBM. And as we look at how those shares are doing so far in overtime, where are they? Now up 11.5%.
Big move for Big Blue.
Yeah, more on the call, I guess.
Yeah. Mike Santoli, want to get your thoughts on this because this has been a turnaround story over a number of years.
Sure, and IBM is getting credit for the tangible progress it's making in being a participant in all these big, important trends. Obviously, a lot of hard work in kind of hiving off some of the slower growth assets. It now has a valuation that's basically at a 20-year high. It's above 20 times earnings, but if it's an AI play in some measure, that's not very expensive in the current market. Oracle's well higher than that right now, even after Oracle was quite cheap. So it feels like things, IBM's finally able to tell this story that they are, in fact, in the parts of the business that you'd want to see. For years, I've said there's kind of an Accenture inside of IBM, if people wanted to recognize it. You mentioned consulting's not that strong, but Accenture trades even higher at a valuation than IBM. So it feels like the street is comfortable giving them credit for it.
Duly noted. And in the meantime, ServiceNow results are out. That stock is lower right now in overtime by, let's see, about 9%. Perhaps a little bit more than that, but it's moving around. ServiceNow reporting Q4 numbers in line on the top and bottom lines. Also a strong dollar story here to be aware of. Q4 revenue was $2.96 billion, in line with consensus. So is non-GAAP earnings per share of $3.67. Now looking forward, ServiceNow saying it's making some significant adjustments in how it sells software, moving to some elements of a consumption-based model for AI and data solutions. That's going to mean giving up some initial subscription revenue to drive adoption. It means investors are going to have to factor that into the guidance number. ServiceNow saying to expect Q1 subscription revenue between $2.995 and $3 billion, which would be slightly below the expectation of 3.03, but you'll want to factor in this new revenue model. I did speak with CEO Bill McDermott about these results and this consumption shift. He said on consumption, talking about how that's factored into one of their higher tier plans already. As they, that being customers, consume them, we give them a very nice allocation for how much they can consume, talking about the AI capabilities. And only when they go above that metered level does the consumption pricing kick in. Also, which is a win-win because they wouldn't be using it a lot if they weren't getting a lot of value out of it. I also talked to him about the impact of this strong dollar of currency. ServiceNow being a global company as well, similar to IBM, he said, it's currency, John. The FX headwinds are pretty dramatic. It's a couple $100 million. It's obviously coming from EMEA. It's coming from UK. It's coming from Japan. Also Australia. You have a strengthening dollar since October, which is absolutely creating an FX headwind. If you look at CRPO and RPO, those are pipeline measures, you're talking about a couple of percentage points that would be tied up in FX. I was asking him there if there's a growth slowdown or if this is an FX headwind that we're saying, and he's saying it's FX. Also, a Google Cloud partnership announcement here. I asked him more about what that's about and what it brings to customers and potentially revenue. He said, basically putting ServiceNow on the Google marketplace, and we're focusing on things like simpler procurement, faster deployment, and compatibility with all the native GCP tools and infrastructure, and providing agentic AI out of the box. This is going to drive a no swivel chair world of complete automation in the enterprise, and this will be big in both the public and the private sector. Also a partnership with Oracle that they're announcing here. Talk to him about DeepSeek as well and what he sees this meaning for ServiceNow. McDermott says, these models are being commoditized at a faster rate than anybody could have possibly dreamed of. Met with one of the founders of the most well-known one, and he said the price this year is 1/16 of what it was last year. So the overall trend is super good for platform and application vendors, since the differentiation will happen at that level and not at the LLM level, Morgan. So he's saying it's going to be good for ServiceNow. The stock now down about 8.5% on overtime. We'll see how investors digest this partial consumption model shift and the FX as well. Adam Christofouli, I want to go to you on this one too, because ServiceNow has been one of the real software high flyers in the AI space, and it's taken a bit on the chin, at least initially here.
Yeah, so I think the change in the pricing structure is significant, and this has been a concern for software investors now about how they will incorporate AI. Not only how will they incorporate AI into their products, but then how will they charge customers for it? Usually it has been on kind of a per seat basis, but in theory, AI will disrupt that and mean fewer seats. And so they have to kind of change how they're pricing the product, and that can create some near-term disruption in the income statement. And we're kind of seeing that to an extent with ServiceNow. And then also, like you said, FX is definitely going to be an issue for a lot of international companies, including software. But for me, it's the consumption, the pricing change on consumption versus seats. That's definitely significant. That can reverberate throughout all of software.
All right. Adam, thanks. Mike, I'm sure we'll see you in a bit. We're just getting started here on Overtime. Up next, Wedbush analyst Dan Ives joins us here on set with his first take on the Mag 7 results so far from Microsoft and Tesla. We're still awaiting results from Meta.
And Apollo's Torsten Slok and former Council of Economic Advisors Chair Cecilia Rouse will be with us to break down Fed Chair Powell's message to the market. What a day it's been, and we're still going. Overtime is back in 2.
CNBC. Live ambitiously.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward. The number one soft skill is flexibility, preparation,
confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
I see ambition as enriching your entire life, your financial life, your personal life, and the lives of people around you, your community. My ambition is to build people up.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show.
but we actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weekdays. Live from the New York Stock Exchange, Halftime Report, CNBC.
Welcome back. Tesla out with results at the top of the hour. Let's get back to Phil LeBeau with more from the report. Phil.
A couple of nuggets from within the report, and the conference call coming up at 5:30 is really where we're going to get greater detail on a number of things. Energy storage, which has really been a growth area for this company, up at 50% is the expectation for 2025. More affordable models, they've talked about this for some time. They are reiterating that they expect to begin volume production in the first half of 2025. And then Cybercab volume production, that is expected to start in 2026. That's a reiteration of where they've been before. Again, shares of Tesla down a little over 2% following a miss on the top and the bottom line. Guys, back to you.
All right, Phil, thanks. Now let's bring in Dan Ives, Wedbush Securities Global Head of Technology Research. More on Tesla and Microsoft as we're still waiting for Meta's results. Meta's late, but Dan Ives, Tesla is here, and it's way off the lows here, now down just 2% after missing on the top and bottom. Is it about these cheaper vehicles?
Yeah, I think there's two key things here. One, committing first half of the year that they're going to produce those. I think there was a lot of concern that they weren't. This potential could push out in 2026. They doubled down there. And then the other thing that's important in terms of Cybercab and autonomous, basically saying robotaxi, you'll start to get parts later this year, full volume production 2026. Look, 90% of the story right now, it's about AI, autonomous, Cybercab, what I believe is at next level. Obviously, numbers itself a little sort of soft, but that's the key. I think it's probably a stock that's going to be up tomorrow.
Microsoft's also off the lows. What matters here, particularly in the commentary, this is a earnings call where we get a lot more on guidance.
Yeah, of course. And this is one you always really have to wait till guidance, but $13 billion. In terms of that AI trajectory, I mean, that's really what the street's focused on, because this is something that's ultimately going to be 20, 25, ultimately $30 billion. That's what's driving this Nadella and Microsoft story. And even though if you look at it, you talk about currency, that could be a bit of a headwind. I think this is one, as your growth actually accelerates, I think the conference call is going to be bullish. They doubled down on the $80 billion in terms of CapEx, especially this week, here with DeepSeek and everything else. I think this is another one. I look at this numbers. I feel more bullish because that ultimate AI number, I mean, that's really the lotto ticket right now if you own Microsoft.
I want to go back to Tesla for a second. How important is it, given everything that he is focused on right now, including in Washington, for Musk to be on the call? And when you do think about something like robotaxi and autonomous driving, especially on a day where Waymo is announcing that it's going to expand its own taxis to 10 new cities, how much now hinges on that policy green light happening with this administration?
Yeah, I mean, look, it comes down to the deregulatory environment, the Musk bet on Trump, in terms of the bet for the ages. Now you need to see it in terms of the autonomous roadmap from a federal perspective. It is important. Obviously, Musk is on the call, talks about robotaxi, talks about ultimately the timeline there, the view of autonomous, unsupervised FSD. Look, Morgan, these are really the things that are going to drive the stock. I mean, look, earnings itself are important in the next quarter or two, but I believe when you look out, I believe the AI autonomous story, that's worth $1 trillion alone. That's really going to be front and center on this call, along with John asked about first half of the year, making sure doubling down these lower cost vehicles are out there. That's how you get to 20, 30% type of volume growth in 2025.
Given the fact that we had this DeepSeek shakeout in the market, to start the week. We just got some comments from some of the CEOs, tech CEOs that John just spoke to with earnings. We're still waiting on Meta. Zuckerberg just earlier this month actually had some interesting commentary on the Joe Rogan podcast about DeepSeek. How to think about what this does to drive down cost and who the beneficiaries are going to be, because there are going to be beneficiaries, just thinking about some of the comments from ServiceNow, for example.
Yeah, and look, I mean, it comes down to that 65 billion. They're going to reiterate that probably 3 times in terms of CapEx for Meta and Zuck, 80 billion from Microsoft. Look, DeepSeek, it was a scare, but and I continue to view it, it's bullish for the overall AI revolution, because going back to ServiceNow, Palantir, Salesforce.com, it's the use cases, it's software. That's not slowing it down in terms of what we saw in DeepSeek. And I think if you look at that, it was a shot across the bow. But ultimately, what we're going to look out in the next week or two in terms of earnings, the AI revolution is actually accelerating. And I think that is really going to be sort of a narrative that we hear even tonight.
Meta's teasing us. It's way late. What do you want to hear from them? Maybe even when it comes to Llama and its DeepSeek commentary.
Yeah, I think 3 things you want to hear. 1, 60 to 65 billion. Just that reiteration, just showing the confidence from Zuckerberg and Meta from a CapEx perspective. 2, talking about all 3 billion plus, DAUs. Like, how are you going to monetize that? Showing the strategy from an AI perspective. And then, of course, advertising. Is it high teen growth? Our checks here at Wedbush continue to be much more bullish when it comes to what we're seeing on the advertising side. They're in a position of strength. And I think you've seen it with Zuckerberg and some podcasts, and even when he's talked about, this is a company that's on the offensive. They know that they're in a position of strength. Now show it, monetization. Obviously, they want to be on this conference call. I think it's really an important one, probably one of the most important ones in the last 4 or 5 quarters.
And we know, at least from what we heard from Meta last week, that the CapEx continues at up to $65 billion this year.
Yeah, look, DeepSeek, we continue to view it. It's going to be just a small blip in what's going to be a multi-year AI revolution. It is not changing, and you're going to see that tone from these tech CEOs tonight.
Okay, Dan Ives, great to have you here.
Thanks.
Well, we have much more reaction to the Mag 7 results ahead as we do continue to wait for those Meta results.
Come on, Meta. After the break, a check on retail. CEO of VF Corp, which owns brands like Vans and North Face and Timberland, is going to join us fresh off earnings. We'll be right back.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Kelly Evans, The Exchange, CNBC.
We are seeing more agility in many other territories than the European one. Luckily, the good news is that I think not only we in the foundation, but I think in general in Europe, people have woken up to that.
The 27 different countries, even my home country, Germany, they are way too small to have that seat on the table. And that's, I think, what the European Union missed out on, to have a joint foreign economic policy and say, look, these are the standards, those are the rules, we want to engage together for the greater good of the world. And that's missing, so that basically means that they need to get their act together quickly.
Europe is lagging in growth. The UK is ahead compared to Europe, still not as strong as the United States. But both these economies can use growth. And part of getting that growth is to unleash the capitalist instincts and what we call animal spirits into their economies, which means a better balance between regulation and opportunity.
Still awaiting Meta's results, which we had expected at the top of the hour, but some other headlines on Meta just crossing related to President Trump. Let's get to Julia Borson with the details. Julia.
Morgan, that's right. I'm here awaiting those Meta earnings. But in the meantime, the Wall Street Journal is reporting that President Trump has signed an agreement calling for Meta to pay $25 million to settle a 2021 lawsuit that Trump brought after the company suspended his accounts. This was following the attacks on the U.S. Capitol back in 2021. Now, according to this Wall Street Journal report, $22 million of that will go towards a fund for Trump's presidential library, the rest going to legal fees and the other plaintiffs who signed on to the case. Now, we reached out to Meta for comment. They say they are neither confirming nor commenting on this Wall Street Journal report. But we are still just awaiting the earnings results, which should have been out about a half an hour ago. Meta shares have been trading around the flat line. Back over to you.
All right, Julia Borson, thank you. Meantime, we have Levi Strauss earnings out. Pippa Stevens has the details. Hi, Pippa.
Hey, Morgan. Well, Levi Strauss is falling here on like guidance, but let's start with the Q4 results for their EPS. It was 50 cents adjusted. That did beat estimates by 2 cents. Revenue coming in at $1.84 billion. That was also ahead of the $1.73 billion that Wall Street was looking for. But again, their guidance not great, with the company noting a hit due to FX, so they are being impacted by a higher dollar. For the full year of 2025, they see net revenue down 1% to 2%. Versus expectations of up 3.7%. Now, one quick note here, this is their Q4 result, so it's through December 1st, meaning it does factor in Black Friday, but not the entire holiday sales season. The stock here down some 5%. Morgan?
All right, Pippa Stevens, thank you. Don't miss Jim Cramer's exclusive interview with Levi's CEO. That's coming up at 6 p.m. Eastern on Mad Money.
And sticking with retail, quite a ride for VF Corp stock today. The owner of brands including North Face, Timberland, and Vans reported Q3 revenue and EPS this morning that beat expectations, made a new 52-week high at the open, but shares dropped during the day, perhaps because of the Q4 revenue guide. Q3 revenue was $2.83 billion versus $2.75 expected. Adjusted EPS 62 cents versus 34. The Q4 revenue guide was to about a midpoint of $2.12 billion versus $2.25 expected. I spoke with VF Corp CEO Bracken Darrell exclusively this morning about his progress turning the company around.
We've reduced the non-lease debt by about 40% in the last year. We've put the global operating model in place. That's taken. We had 2 years of. It was 2 years ago. The last time we saw growth in the Americas, we saw growth this quarter. You know, we've got, as you said, we got our two of our biggest brands are growing. So we're really getting there. But it's a long-term play, and I really want to make it something that's big and long-term growth sustainable.
We also talked about how much of the turnaround is left. Vans has an overhaul coming soon, and VF Corp's major brands have new executives leading them. The cost work, Darrell told me, should flow into upgrades in how all the brands operate.
I think the cost alignment is kind of an outcome of something else, which is I'm really trying to upgrade all the processes we have in this company to best in breed, and we certainly weren't that when we started. We're on our way there now. When we do that, we're then going to standardize a lot of these processes in the company, not centralize, but standardize them so that we can take the creativity out of that and put it on the products that are coming out, as you said, and the marketing that we're doing.
Trying to put the focus on keeping the brands independent, reinvigorating them. Today's dip in the stock takes it back to about last week's levels.
All right. Well, it's time now for a CNBC News update with Angelica Peoples. Angelica.
Hey, Morgan, a Manhattan judge just sentenced ex-New Jersey Senator Robert Menendez to 11 years on bribery and corruption charges. Menendez was found guilty in July of extortion and acting as a foreign agent for accepting bribes, including gold bars and cash, in exchange for using his influence to help the Egyptian and Qatari governments. President Trump announced this afternoon that he plans to sign an executive order directing the federal government to prepare the U.S. Navy base at Guantanamo Bay to hold up to 30,000 undocumented immigrants. The president made the announcement just before signing the Laken-Riley Act into law, which requires undocumented migrants be detained if charged with certain crimes. And Amazon was sued today by consumers for allegedly tracking them through cell phones without their permission. In a proposed class action suit, consumers allege Amazon secretly tracked their movements by giving developers a code to embed in their apps and sold the collected data, which included sensitive information such as religious affiliations and sexual orientation. Amazon has yet to respond. Back over to you guys.
All right. Angelica, thank you. We've got much more ahead on all of today's after-hours action. Tesla turning higher. We still want to see those results for Meta.
And after the break, Apollo's Torsten Slok and former CEA Chair Cecilia Rouse are going to join us to dissect Fed Chair Powell's message today and what he said about how Washington policy could impact the Fed's goals. Be right back.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
What inventions have transformed humanity?
The wheel, the light bulb, the internet, and me.
Learn how to use AI to be more successful with CNBC Make It's new online course.
It's about how we embrace the technology.
What we're really talking about is automation of tasks.
You're going to feel like they were just always part of your life.
We'll give you examples and how you can use AI tools at work and in life.
Register at cnbcmakeit.com/AI. Special offer ends February 11th.
The age of AI is now.
The climate crisis is a gun to our head, so we better get our act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future, only on CNBC.
Kelly Evans, The Exchange, CNBC.
Welcome back. The Fed keeping rates unchanged and raising some inflation concerns in its statement. In his news conference, Chair Powell was asked by our Steve Leisman about President Trump's demand to a Davos audience that the interest rates to drop immediately, saying he wouldn't comment on it, but noting he's had no contact with the president. Meantime, President Trump just posting on Truth Social, blaming Powell and the Fed for failing to stop inflation. Well, joining us now is Torsten Slok from Apollo Global Management and Cecilia Rouse from the Brookings Institution. She is the former chair of the Council of Economic Advisors. It's great to have you both here. Torsten, I'm going to kick off this conversation with you because we went into this meeting. We knew that the Fed was probably going to hold. It's priced into the market that we're not really expecting the Fed to do much in terms of rate cuts until summer, if indeed the data warrants it. Your thoughts on the change to the statement and then Powell's, I'll call it maybe a little bit of a walk back on the change to the statement.
Well, he did say very clearly, Morgan, that inflation was indeed at a level where it's a little bit more worrying. Inflation was, in their language, no longer making progress at moving towards the 2% target. He did step back a little bit and say that this was not intended to send a signal. But if we take it in combination with the 4 policy areas where we don't know and which he also recognized what's coming, namely tariffs, immigration, fiscal policy, and regulatory policy, some of these policies could be quite inflationary, in particular tariffs, but also restrictions on immigration. So that's why they really took a much more policy-driven approach here. Instead of being data-dependent, they're really more becoming policy-dependent.
Cecilia, I want to get your thoughts on these comments from the president, because the first thing he says in this post is that because, quote unquote, because Jay Powell and the Fed failed to stop the problem they created with inflation, I will do it by unleashing American energy production, slashing regulation, rebalancing international trade, and reigniting American manufacturing. Just in terms of what that does do to the economic picture, especially since some of those things like deregulation could actually be deflationary.
So what the president said in that statement, we already have energy prices are low, which is why, or have been coming down, which is why we see that overall inflation is actually lower than core inflation. But, you know, the bundle of, is not just that bundle of potential actions. When you combine it with the potential tariffs and the uncertainty that's created there, that immigration actions and some of the uncertainty that's being created there, the reforms to TCJA or the extensions that they're proposing, a lot of that really has the potential to be inflationary. So I think there's a lot of uncertainty, and that's how I interpreted the Fed's actions today, which is suggesting we still have a labor market that's doing very well. We have consumer spending that's doing very well. We have inflation that hasn't gotten to where they would like you to see it, and there's a lot of uncertainty, so they're just going to hold.
All right. Well, I want to mention better late than never. Meta's results are out. The initial move in the stock is down about 4 to 5%. We'll get you those as soon as we have gone through them. Torsten, wonder what you make of the president's blaming the Fed for inflation, but at the same time demanding that interest rates drop immediately in the face of policy that he says is going to make the economy better and I guess be deflationary, but clearly that won't happen immediately.
Well, as we're discussing here, I mean, the factors that go into thinking about the outlook is always a list of bullet points that have different implications. For example, if you do tariffs, of course, by definition, the price of goods will be higher, and therefore inflation will by definition be higher, no matter if you do this in one go or if you spread it out over time. Likewise, restrictions on immigration will probably also lift wages, in particular in the three sectors where illegal immigrants normally work, namely construction, they work in agriculture, they work in services, at least according to Pew. So those are different policies, have different implications, so it's very difficult for the Fed, and that's also what Powell was saying today, to come up with a very clear answer to what does the outlook look like at the moment. So that's why I think the conclusion for markets is that the Fed has just almost stepped back from saying we are not really relying on a forecast, but they are more relying on what's coming on the policy front.
Well, sorry, we got to cut this short. Torsten, Cecilia, Meta is moving. We got to get to those results. Thanks to both of you. Julia Boorstin got those Meta results. The stock was down, and then it was up a little bit, and now it's down a little bit again.
John, Meta beating on the top and bottom lines with earnings of $8.02 per share. That's higher than the $6.77 estimated. Revenues of $48.39 billion, beating estimates of $47.04 billion. Daily active people, that's all the people who are using all of Meta's apps, 3.35 billion, a hair ahead of the 3.32 billion estimated. But if you want to look at why the stock is trading lower, it seems to be based on the first quarter revenue guidance. The company guiding to a range of 39.5 billion to 41.8 billion. That compares to an estimate of 41.7 billion. So this means that the midpoint of the range is well below analyst consensus estimates. And then they reiterate the capex in the $60 to $65 billion range, as Mark Zuckerberg announced last week. Stock is bouncing around. We're going to be digging into this report, and we'll be back to you with more.
A lot of bouncing. Julia, thanks. Up next, live reaction to Meta and Microsoft's results and what to listen for on those earnings calls. We'll be right back.
CNBC. Live ambitiously.
Ambition to me is the American dream. It's why my mother came over from Taiwan. It's why people watch CNBC, because they want a better future. I was working as an analyst in Shanghai when my company landed in the news on accusations of espionage. I decided right there and then that I wanted to be on the other side reporting on the news. I love bringing transparency to complicated topics. I think it's so important for us to deliver the right numbers to our audience so they can make better investment decisions. San Francisco was built on ambition, a belief that anyone can disrupt any industry and change the world.
Squawk on the Street, CNBC.
So usually when people think about drone filming, they will imagine a drone high up in the sky, like aerial photos. But I can also fly indoor and close proximity flights, close to people and close to objects safely. Wearing a goggle, it gives you a more immersive experience where you can make judgments a lot more accurately. Whether I want to make it shoot up with high acceleration or to let it drop down to make a dive using gravity. So all these are adrenaline pumping experience for me.
Tong also teaches drone piloting courses to adults looking to improve their skills or make mid-career switchers like himself.
Teaching will help myself or other drone pilots will learn better, especially for drone or anything technology. You need to keep updating yourself. I think it's a good revenue for me to do that.
Meta results just came out. The stock right now down fractionally. Let's bring in D.A. Davidson Managing Director Gil Luria. He's got a buy rating on Meta, also covers Microsoft with a hold. Gil, big beats on the top and bottom here from Meta in Q4. Q1 guidance looks like a miss until you factor in currency with the strong dollar, 3-point headwind. How do you see it?
That's exactly right. I think the knee-jerk initial guidance being lower than consensus. Once you factor for the currency, the guidance is good. If they hit the high end of that guidance of 11 to 18% constant currency growth, investors will be very happy this year. We'll make this probably the fastest growing mega cap this year. So if they can give us those kinds of numbers and give us visibility into that and how investment's feeding into that, I think investors will be happy.
You're doing double duty tonight, Meta and Microsoft. What do you want to hear from both of those calls? And given the results we just got from both of those names, how compelling are they at these levels?
So Meta stayed on track, and again, assuming they don't say something negative about the rest of the year, they should be in good shape. There will be a conversation about CapEx and how the increase in CapEx is going to drive that core business. That's a unique situation for Meta. For Microsoft, it's absolutely critical that they guide to an acceleration of revenue in Azure for the second half of the year, as they've said before, because if you look at this quarter, what happened is they decelerated again. Azure missed expectations in spite of that heavier CapEx. The reason Microsoft has been the underperformer in the mega cap space is that they've increased investments hugely, and yet are seeing revenue deceleration. That needs to reverse itself, or they need to talk about how they're going to rein in CapEx and rein in this investment. They had 29% decline in free cash flow in the quarter. They can't keep doing that without having a drag on margins. So they need to give us an acceleration in revenue and or tell us that CapEx is going to moderate.
Okay. Gil Luria, appreciate it. Shares of Microsoft down 1.5% and Meta are up about 2% right now. Up next, much more on all of the overtime earnings action, including some under-the-radar names that are making big moves. Stay with us.
Sponsored by Sponsored by
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. My ambition starting out was to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You'll learn a lot here at CNBC. It's also a lot of fun.
Diane von Furstenberg's name is synonymous with the wrap dress. This iconic piece of fashion made its debut in 1974 and was an immediate sensation, with 1 million of them being sold in just 2 years. 50 years later, the wrap dress is still a bestseller and a wardrobe staple seen on everyone from royalty to celebrities.
I created the dress, but truly, the dress created me. So why? Well, first of all, the fabric. The fabric was this jersey that molded the body. Then it was the prints. They always move. It changes your body language. And so the more people notice it, the more happy you are with yourself. Somebody said something very funny once. It's the dress that you get the man in and his mother doesn't mind. So it's both sexy and proper at the same time.
Overtime, and let's get back to Julia Borston with more on Meta's report. Julia?
Digging into Meta's numbers here, Meta's revenue accelerated to 21% growth in the quarter. That's up from the 19% growth they reported in the third quarter, and analysts had been expecting revenue growth to actually decelerate. But Meta did guide to decelerating revenue growth in the first quarter, saying that revenue growth would be 8 to 15% year over year, 11 to 18% on a constant currency basis because of those FX headwinds. They don't give full year guidance, but they did say this. They say, we expect the investments we are making in our core business this year to give us an opportunity to continue delivering strong revenue growth throughout 2025. I'm sure analysts will be parsing what strong revenue growth means. I also want to point out here, John and Morgan, that daily active people growth of 5%, that was consistent with the growth of Q3. That growth was expected to slow. And then one last thing, the Reality Labs losses, much less than anticipated, about $500 million less than anticipated. Back to you.
All right, Julia Borston, thank you. We've got a number of transport stocks just reporting results as well. That's after Norfolk Southern reported this morning. So up next, Norfolk CEO tells us exclusively what drove the railroad's earnings beat.
And a few weeks ago, I reported on a story about a tech startup, TopTal, and its legal battle with one of its Silicon Valley financial backers. We've got some updates and clarifications on that story, which you can check out at cnbc.com/Silicon Valley Battle. Be right back.
CNBC. Live ambitiously.
We explore the intersection of innovation, investment, leadership and sustainability in sport.
It's good to try to be sustainable. It's all about technology in the end.
From sailing,
the athletes have to act sustainably at events, and they have to really focus on what are they doing to give back.
To an ancient martial art.
This experience is a new experience. You can think of it as a new discipline.
Because of no physical contact, we can fight regardless of the age or gender.
Or in the next CNBC Converge.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
Frank Holland, Worldwide Exchange, CNBC.
If you have 1,200 people dancing and you're capturing the heat from those people dancing, you can heat about 70 houses. So it's quite significant.
This venue in Glasgow uses the same techniques as geothermal energy, a low-carbon technology capitalizing on the Earth's energy stored underground.
The body heat system is a heating and cooling system that captures heat from a venue here, SWG3, cools down the space, keeps everyone the right temperature by taking that body heat out through some heat pumps in a plant room and then into an array of boreholes, charging up those boreholes as a big thermal battery in the ground. And then during the week, during the day, when the venue needs heating, we pull the heat back out through the heat pumps and back into the venue.
It's like, come here and dance, do what you do every Friday, Saturday night, and you're playing your part.
Sponsored by
Welcome back. Shares of Norfolk Southern ending the day higher after reporting an earnings beat this morning. The railroad is a turnaround story, and investors are focused on its ongoing efforts to boost service, efficiency, and in turn, profitability. Mark George, the CEO, telling me in an exclusive interview he expects the momentum to continue this year, in part because the railroad is taking market share, but also because the economic backdrop is, quote, supportive.
It's a little bit of both. I think the consumer remains strong. We're seeing that in our intermodal volumes. But at the same time, we know we're recapturing share because of our improving service product. So I'd say on the merchandise side or the industrial product side, we're finding more and more opportunities to take back some share that we had lost after a few years of weak service. And on intermodal, it's a combination. We're taking share off the highway, as well as we're taking basically growth that's in the marketplace.
Now, intermodal has been a bright spot for rail results really across the industry this quarter, even as volumes of some goods tied to the industrial part of the economy have been soft. I asked George if he expects industrial activity to begin to recover this year.
I think there's a good chance that we start to see even more activity this year. I mean, we had, 149 active industrial development projects happening on our network this year. These things take they take time, for them to really start to gain traction and manifest into a live factory with volume. I think that activity is picking up for sure.
Now you can watch more of my exclusive interview with the CEO of Norfolk Southern at CNBC.com. And we will have much more on transport's earnings and what they're signaling about the economy tomorrow, when I speak with UPS CEO Carol Tomé in a first on CNBC interview. That is going to happen on the exchange at 1 p.m. Eastern.
Interesting tape. Breathless,
Woo!
Right? Meta made us wait. IBM is still up about 8.5% here in overtime. I didn't mention it, but I also talked to Arvind Krishna. It's been 5 years since he was named CEO. He didn't start the job officially until April, but he was named in January 2020. The stock is flirting with levels up near 250 here in overtime. That would put it back more years than this 5-year chart will tell me.
Yeah, it'll be interesting to hear what guidance is from Microsoft on the call. We had major averages fractionally lowered. This time tomorrow, Apple results as well. That does it for us here at Overtime. 1 p.m. Eastern.
Interesting tape. Breathless, right? Meta made us wait. IBM is still up about 8.5% here in Overtime. I didn't mention it, but I also talked to Arvind Krishna. It's been 5 years since he was named CEO. He didn't start the job officially until April, but he was named in January 2020. The stock is flirting with levels up near 250 here in Overtime. That would put it back more years than this 5-year chart will tell me.
Yeah, it'll be interesting to hear what guidance is from Microsoft on the call. We had major averages fractionally lowered. This time tomorrow, Apple results as well. That does it for us here at Overtime.
Fast Money starts now.
Live from the iConnections Global Alts Conference in Miami Beach, this is a special edition of Fast Money. Here's what we've got on tap for you tonight. A big night of big earnings, nearly $6.5 trillion worth of companies reporting after the bell, from Microsoft and Meta to Tesla and Big Blue. We've got all the numbers covered. We're bringing you all the trades. And Trump versus the Fed, the president having some harsh words for the central bank after it held rates steady at its latest meeting. What he had to say and what the Fed had to say about inflation. Plus, a Bitcoin bonanza, the crypto up nearly 50% since President Trump was elected. What the new administration will mean for the coin and the rest of the crypto space. We've got a huge slate of guests tonight to cover all of that. Goldman Sachs' Elizabeth Burton, Jefferies' David Zervos, Armin Panosian, co-CEO of Oak Tree Capital, and Steve Kurz of Galaxy Global. You won't want to miss a second. Welcome to Fast Money here in Miami. I'm Melissa Lee, and I'm joined on the terrace at the Convention Center by Dan Nathan and Guy Adami on this very, very big day two.
Huge
of
day.
the Global
It's been a
Alts.
great couple days.
It has been.
You've been out front. People love Melissa Lee. I just want people to understand.
They don't think you're bad either.
Well, let's not get carried away. Prolific. She's prolific, guy.
But it's a really great conference, and we've got a really great lineup tonight.
Yeah, and it's funny. We started this week out talking about this DeepSeek and what it meant for one of the biggest secular trades that has really gripped the markets. Obviously, a lot of the performance over the last 2.5 years has been tied to that. And it feels like, and especially as we get into tonight's earnings, there's kind of some kinks in the armor here a little bit. We're seeing decelerating growth. You could have made that call on any occasion over the last 2 years, but maybe this is the week where we start to see it a bit more.
All right, well, let's dig in here. We start off with a big trifecta of big tech earnings shares of Microsoft, Meta, Tesla, all on the move after their reports. We've got full team coverage of the results. Julia Borson is standing by, and Meta. Phil LeBeau has got all the details on Tesla. But we start off with Steve Kovac, who's been watching Microsoft. Steve, what's the latest?
Yeah, Melissa, this is a big one after that DeepSeek moment coming on Monday. But look, here's what we got now. Beats on the top and bottom lines for Microsoft. EPS came in at $3.23. That's a beat by 22 cents. Revenue, another beat here, $69.63 billion. Street wanted $68.78 billion. But what you guys really care about is all the AI stuff and cloud stuff, right? So Azure was a slight miss here, showing 31% growth. Street was looking for 31.1% growth. That's actually lower sequentially. We saw 33% growth in that segment back in the fiscal Q1. And then of that, AI made up 13 percentage points of that Azure growth. That is continuing to increase and become a bigger part of the Azure story. Meantime, Microsoft says it's a 157% increase year over year for artificial intelligence revenue across all cloud, not just in Azure. And then another new figure here is artificial intelligence business over at Microsoft. They're saying it's at a $13 billion annual run rate. That means they took the revenue from this current quarter we're talking about, multiplied it by 4, and they say they're now on a run rate of 13 billion and change. And then OpenAI, those losses over at OpenAI, which Microsoft, of course, is a major investment in, that's taking a hit on earnings over at Microsoft. Microsoft is saying $2.29 billion can be attributed to that OpenAI losses. They were expecting $1.5 billion when they gave guidance last quarter, worse than expected. And then capital expenditures, of course, a huge topic of discussion here amid the DeepSeek conversation. $22.6 billion spent in the quarter on CapEx. Look at this chart here. That is almost double what they spent in the year-ago quarter on CapEx. Huge question coming up on the call at 5:30. PM, guys, is whether or not they need to be spending the way they've been spending. We know that $80 billion figure is good through the end of June. What happens after June? That's the big question, guys.
All right, keep us posted, Steve. Thank you. Steve Kovac in San Francisco for us. It does seem like the weak Azure number is front and center, at least right now, until they talk about guidance for CapEx on the call.
Yeah, but 1/10 of, I mean, it's not a miss. I mean, it's basically in line. And I look at this and say revenue's up 12% year over year. Margins were better. I think what it comes down to is valuation. You know, you're talking about a stock that's probably trading around 30, 31 times next year's numbers. And in an environment now where valuation is front and center, given what we heard on Monday, that's concerning. I don't think you're going to sell the stock down to 415 or so, but it's one of those quarters where we're going to continue to go sideways. By the way, Microsoft made its all-time high in July.
Yeah.
The broader market's been doing extraordinarily well since then. It's been going sideways to slightly lower ever since.
Yeah, and I'm not so concerned about, coming in line at 31% versus the estimate, like I just said, of 31.1. It really is that deceleration from 34% last quarter to 31% this quarter. And then you have to start asking yourself, okay, well, they have this really cozy relationship with OpenAI. A big part of that deal over the last 2 years is OpenAI's use of their cloud infrastructure. And so if that relationship is being strained in everywhere you look.
Because of Stargate.
Because of Stargate, because of a whole host of other things. I mean, OpenAI, I think quietly has been complaining about either their capacity, that sort of thing. So at the end of the day, I mean, the Microsoft story was an early beneficiary in the public markets of this trend starting out in early 23. It might be one of the ones that's waning. And to Guy's point about the stock, I think investors are sniffing this out. It made a high in July of last year and has really underperformed many of the other names in the space.
In terms of CapEx guide, if they talk about it for next year, if it comes in and it looks like 25 is the peak, is that good? The stock goes up?
I think it would be good.
Yeah.
I think you'd be saying, okay, we've got peak CapEx, we're going to the other side of it now.
Yeah.
They've spent all the money they need to spend, we're sort of decelerating. I think the market would actually probably like that, and you'd see the stock bounce on the back of that.
Yeah, it depends. If you think about what we just heard of Microsoft and Meta over the last few weeks about their CapEx and what they're expending for this year in 2025, I mean, it seems like they're in concert, at least reiterating some of the numbers that they've given over the last few months or so. I suspect you don't see a ramp up of those. I think the DeepSeek and the Alibaba mark, I think a lot of folks are going to kind of, not too different what Fed Chair Powell said. They're not going to be in any hurry to do, obviously, to raise it. But in this case, I don't know. I think we're probably going to hit a pause here for the next quarter or so.
All right, let's get to Meta now. Shares are moving higher on a Q4 beat here. The conference call just kicked off top of the hour. Julia Borson's been listening in. Julia.
Melissa, Meta CEO Mark Zuckerberg is on the call right now talking about his focus on AI, and in particular, how the company's AI assistant called Meta AI will be transformative this year. They expect it to reach 1 billion people. He also talked about how important it is that people's AI assistant be personalized to them. And of course, Meta has lots of information about what kind of personalization we might want. Now, looking at the stock up about 2% this past quarter, Meta's revenue growth did accelerate instead of decelerating like analysts anticipated. Meta did guide to decelerating first quarter revenue growth of 8 to 15% or 11 to 18% on a constant currency basis. And after announcing up to $65 billion in CapEx last week for the year, the company gave some more insight into its guidance of up to $119 billion in total expenses for the year, saying we expect employee compensation to be the second largest factor as we add technical talent in the priority areas of infrastructure, monetization, Reality Labs, generative artificial intelligence, as well as regulation and compliance. Now, Meta did not give official full-year guidance, but said this: we expect the investments we are making in our core business this year will give us an opportunity to continue delivering strong revenue growth throughout 2025. What's strong? We'll see. There were also a couple of upside surprises. Daily active people growth, stronger than expected 5%, and Reality Labs lost less than $5 billion. That's far less than the $5.4 billion loss that analysts were expecting. Melissa?
All right, Julia, thank you. Julia Borston on Meta. And of course, she'll keep us posted on all the developments. The D word, DeepSeek, hasn't yet been mentioned, although we are only 8 minutes into the conference call here. But it sort of sits in this cross section of the valuation is good. Plus, theoretically, DeepSeek should help agentic AI, and that's exactly what Meta has.
This is the third quarter now, and we've talked about this. There are two, in my opinion, there have been two companies that have absolutely figured out AI. It's Walmart and it's Facebook. And how do you figure that out? Operating margins came at 48.3%. The street was at 42%, which means if you know what, you're going to slow down on the revenue side, that's more than offset by the margin improvement, which you're seeing in EPS gains. I mean, that EPS number is ridiculous, which means the stock now at an all-time high, to your point, is still reasonably valued. And for everything I get wrong, which is a lot, Facebook is one I think we've been doing a decent job with.
You know, listen, this is no longer a hyper-growth company. You just talked about operating margins. That's great that they're getting that. So obviously they're getting leverage from some of the investments that they've made. But expected earnings and sales growth for the next 2 years, about 12, 13% or so. You know, you better see that sort of margin, continued margin improvement. You know, and Julia just mentioned Reality Labs and the loss is not as big as expected. Go back and think about the 70% the stock lost from its highs in 21 to its lows in 22. It had a lot to do with Reality Labs losses, and now the fact that they were able to reposition a lot of that spend and get the benefit. I just wonder if it's kind of pulled forward. Last thing I'll say, DeepSeek, you know, open source model, the Alibaba model, open source model, Llama, which is Meta's open source model. If those are blocked here in the US, that should benefit Meta to some degree. You're going to see a lot of developers working around Llama, especially if they're trying to keep up with some of the DeepSeek that's outside the US.
By the way, a text from the chairwoman on buybacks from Meta. The street was looking for $6.7 billion, and they bought back zero. So that's sort of an interesting development in light of all the talk about spending and where they're spending their money. They're not spending their money on shares, at least in the latest quarter.
Can we say hi to Karen? She's watching.
Well, we are. Hello, Karen. Wish you were here. All right, let's get to Tesla here. Shares up a couple percent. This despite a top and bottom line miss. Phil LeBeau's got all the details here. Phil.
And Melissa, that conference call starts in 20 minutes. And one of the questions is really, most of the questions are going to be focused on what's the outlook for the cyber cab, full self-driving. We'll talk about that in a little bit. Let's run down the numbers. You mentioned the miss on the top and the bottom line. 73 cents a share. The street was expecting 76. Revenue coming in, basically $1.5 billion shy of expectations. Free cash flow of just over $2 billion. When you look at their deliveries, people were expecting them to give some type of guidance. Increase of 10%, increase of 20% in 2025. They are not doing that. All they are saying is that the automotive business is expected to grow in 2025. Perhaps we'll get greater color on that in about 20 minutes. In terms of the outlook, the energy storage business, which has been really the growth story in the last year, it's expected to continue growing in 25, up by 50%. That's their expectation right now. Lower priced model production will begin in the first half of 2025, and then Cybercab volume production is expected to start next year, though they do say that they expect to start launching it. That, along with full self-driving in certain markets in the United States later this year. As you take a look at shares of Tesla, remember the call starts in about 20 minutes. One last note, Melissa, the automotive gross margins, excluding zero-emission vehicle credits, the expectation was for it to come in at 16.3%. You see the impact of lower cost models, the discounting, it came in at 13.7%. Guys, back to you.
All right, Phil, keep us posted again. The Tesla conference call begins in just about 15 minutes' time. Another interesting development in the Tesla release is the booking of a Bitcoin gain or digital asset gain that was $600 million in the quarter. So that is something different from what we normally hear from Tesla. The shares look impervious to bad news at this point.
So we play a lot of games on CNBC's Fast Money. And one of the games we play is, if you told me this yesterday,
what would the stock reaction be?
What would the stock reaction be? You know that game.
I'm familiar.
If you told me they're going to miss EPS, going to miss revenue, and margins would come in at 16.3%, which is going back like a year or so when we thought we saw trough margins, say, okay, where's the stock given the run it had post-election? I'm down $50 easy. And it's not. It's actually up in the after hours. So clearly they're not looking at this as a car company anymore. They're looking at it as something else. But, you know, the free cash flow number of $2 billion, which Phil said, you just explained, I think, the reason why. So label me a skeptic on this one, Mel.
Yeah, I wouldn't say it's a hilariously bad quarter, like I said a couple quarters ago, but they missed on every key metric. I mean, when you think about it, the company is embroiled in a price war. I think a lot of those EV tax credits might be gone, despite the proximity of Musk to Trump. They're in a disastrous situation, in my opinion, in China. They're trying to make this lower end vehicle here in the U.S. to kind of stimulate growth. They did not have growth last year. The fact that they are not kind of guiding towards anything like that. It should make you think twice about where they are. Rates higher for longer. Not a great thing. I know the guys last night, Vinny and Porter, mentioned that 2 years ago they were having a fit, or Elon was on the call about rates and what that means for them. And then the last piece of the puzzle, Elon's gone back and forth about tariffs, about Chinese EVs. Listen, if they don't sell enough of the cars that they make in Shanghai, which is about half of their production, then they go to Europe. And Europe already has stiff tariffs on Chinese EVs. So I don't think they get out of this anytime soon. Last thing I'll just say is, like, if you want to buy this stock on robotaxi and mass production of those things at the back half of this year to be deployed next year, have at it.
This is a cult stock. This is a cult stock, though, at this point. This
I'm
is
not going to use that
stock.
term because I got to go to an airport tonight. I'm not going to get whacked. You heard the guy on the horn before. Anyway, please.
But that was the point. I mean, you brought up Porter and Vinny. They're saying we are invested in Lucid because all the money is going to Tesla because it is a cult stock at this point. It is not trading on fundamentals. We are seeing that in the after-hour session.
Yeah,
proof of that.
Listen, and yes, I think that's exactly right. I mean, if based on all the metrics that I'm looking at right now, history suggests it should be significantly lower. It's gotten back what it lost during the day, so maybe that's part of it. But again, the math sort of doesn't work at this point, and now people are looking this through a different lens, I guess.
Yeah, let's get to NVIDIA here. Interesting move in NVIDIA, down 4% today in the regular trading session. Up, though, after hours. Bloomberg reporting the White House is considering tighter curbs on its sales to China. Megan Casella's got the details here. Megan.
Melissa, that's right. So that Bloomberg report says that Trump officials are having what they called early conversations about putting additional restrictions on NVIDIA's chip sales to China, and specifically focused on the H20 chips. These are those scaled down AI chips that had initially been designed to get around current U.S. export controls on NVIDIA's sales to China. The company saying in a statement this afternoon that the Biden administration's thresholds, they say, had been set on performance levels reached 5 years ago, and that it's ready now to work with the administration as it pursues its own approach to AI. Now, the White House and Commerce Department did not respond to my request for comment on that report, but I would caution that it's very early for any decisions on export control policy. No one is yet leading the Commerce Department or even the Export Controls Office within Commerce for the administration. So we're in very early stages here. I will add, though, Commerce Secretary nominee Howard Lutnick did today say in his confirmation hearing that he will be very strong and rigorous in his approach to export restrictions toward China in order to ensure that the U.S. remains a leader on AI. So it could suggest that this type of policy will be supported moving forward. Melissa?
All right, Megan, thank you. Megan Casella. For more on all things tech and tech earnings, let's bring in Fast Money friend Gene Munster, managing partner at Deepwater Asset Management. Gene, great to have you with us.
Hi.
Let's start off at Tesla, because that's sort of where we left off before with the traders here on the desk. What do you make of this quarter? It's a little head-scratching in terms of the reaction in the after hours, given the quality of the print.
Yeah, this was, Melissa. I was shocked to see the stock up. I mean, this was messy. I think, Guy, what did you say? This is a cult stock? Ultimately, I think that the numbers are pretty choppy, and it's just hard to see why it's up right now. I think it's basically confirmation that people think that this is more to go.
What do you want to hear from Microsoft?
It's all about CapEx, and Zuckerberg said it related to Microsoft. It's all about CapEx. But I want to highlight probably the most important point from these earnings calls so far. Zuckerberg's comments that they're going to spend hundreds of billions on CapEx. I mean, that's really reassuring. That's what we're looking to hear from Microsoft, how much they're spending on CapEx.
Do you think that we will hear guidance on CapEx for 2026? And I know that is a mile away, but a lot of investors want to hear that Microsoft, this year's $80 billion is going to be the peak.
I think this, coming into this earnings, just taking a step back, Melissa, this is all about what's going to happen with CapEx. And as I mentioned, Zuckerberg's comments about the hundreds of billions, to put that into perspective, this plays into what's going to happen in 2026. His comment about hundreds of billions. So far, Meta's invested probably $50 billion in CapEx. So just to put some context about how far along the road we are. And I think that as we kind of play that forward to 2026, if he's saying hundreds of billions of dollars, and you have to kind of, given the competitive nature of how these companies are building the AI infrastructure, the comments that Zuckerberg's making is probably going to be similar to some of the comments that we're going to hear from Microsoft. And to get to that hundreds of billions probably means that this AI infrastructure build continues into 2026. And so I think that this is really positive. As I kind of process everything that we've heard so far and seen everything at Tesla, Meta, and Microsoft, the biggest takeaway so far is this is really positive for NVIDIA, even despite what's happened with kind of the China piece, because, as you said, Melissa, that outlook for 2026 on the CapEx is just really, I think it's upbeat. And keep in mind, Zuckerberg didn't have to reiterate this. He didn't have to double down on what he had said last week. And given what's happened earlier in this week, I think it's really encouraging regarding just the broader AI trade from the very early part of what we've heard from these companies so far.
Hey, Gene, you just mentioned, it's NVIDIA being a beneficiary of all this. We know that, right? So a couple weeks ago, Microsoft, Meta, they gave their CapEx guidance for the year. So here we are, they're reiterating it. And, let's see how this stock, how far it could run a little bit if it could fill in that gap from Monday. But, going back and looking at that chart over the last 3 years since it really took off, there's not a single gap to the downside. There's plenty to the upside. So I guess the question here is that, is it going to be enough as far as this guidance is concerned, given the headwinds that we might be seeing around the globe with some of these open source models out of China? Like, is there a chance that the trade is just done for a bit?
So this is specific to NVIDIA, or the NVIDIA, maybe the broader AI trade. I think, again, we're piecing together data points real time. That's what happened with DeepSeek, because it was one data point and the market had to extrapolate it I think, out to several years. Now, since then, we've had some more data points. And like you said, with NVIDIA and their business, and I think the bottom line is this, is that if CapEx infrastructure continues to remain strong, we're going to see models, even if they're novel models like we saw from DeepSeek that can be produced at lower prices, they're still going to want to build the infrastructure to get those models out faster. So if we continue to see that, I think that this is that build out, which is what we're hearing tonight from Zuckerberg. If we continue to see that, I think that not only will the hardware spend more broadly continue, but I think that the software piece is going to start to play out. And so I think that this broader AI trade is still very intact.
Gene, thanks so much. Great to get your take. Gene Munster.
Thank you.
Coming up, we'll keep an eye on all of the after-hours tech earnings. We are 10 minutes away from Meta, as well as Tesla's calls, 21 minutes into another call here. Meantime, we've got other names reporting: Las Vegas Sands, IBM, Whirlpool, and more. The numbers from the quarter straight ahead. But first, the Fed pausing its rate-cutting campaign, sending a warning about inflation. Jefferies' David Zervos and Goldman Sachs' Elizabeth Burton join us next to lay out the impact and where the markets are heading from here. You're watching Fast Money in Miami, live from the iConnections Global Alts Conference. We are back in 2.
AT&T has a new guarantee because most things in business are not guaranteed. Like a distraction-free work environment. Get those steps in, Kevin. Your coworkers keeping things confidential? Oh, she's spilling all the tea. Or office etiquette. Yeah, that's not guaranteed.
I know you can see.
You know what AT&T guarantees? Connectivity you depend on, the deals you want, and the service you deserve.
Can I get that logo bigger?
Or we'll make it right. That's the AT&T guarantee.
Individually, each of us is great. But from here, you can see we're one big team. At Atlassian, we believe real progress takes all of us, working together on new sources of energy. Cars that drive to the future. Even pizza deliveries. Together, we can go beyond where we've ever been, collaborating from anywhere on everything. Atlassian makes software for teams to do what is impossible alone.
Interactive Brokers pays up to 3.83% on instantly available cash in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available cash in your brokerage account. The best informed investors choose Interactive Brokers.
Experience the power of CNBC Pro. All new investing tools securely linked to your brokerage accounts. Become a smarter investor with the power of CNBC Pro. Go to cnbc.com/getpro now.
Meet Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com.
Hi, I'm Cade Courtley, and welcome to the Ford Patriots Buy One, Get One solar generator event. Claim the Patriot Power Generator 2000X, and you'll get a free Patriot Power Sidekick with 2 free solar panels. These are 2 of Ford Patriot's silent, fume-free solar generators that can power your fridge, TV, and critical devices without ever needing gas. Every American should have the peace of mind that comes from having backup power. Visit FordPatriots.com to secure your free generator and solar panels now.
I have been using the GLP-1 injections through hers. I have lost 30 pounds.
Hers has changed my life.
I fell back in love with myself. See if GLP-1s are right for you. Start today at forhers.com.
Welcome back to Fast Money. Stocks closing lower, but off their worst levels of the session after the Federal Reserve left interest rates unchanged. Fed Chair Jerome Powell striking a more cautious tone, warning of sticky inflation and signaling that the committee is not in a hurry to cut rates. President Donald Trump reacting on Truth Social in just the last hour, writing that Powell and the Fed failed to stop the problem they created with inflation. The president adding that his policies around trade, deregulation, and energy will, quote, make our country financially and otherwise powerful again. Joining us here in Miami is David Zervos, Jefferies chief market strategist, and Elizabeth Burton, client investment strategist at Goldman Sachs Asset Management. Great to have you both here on set in Miami. Elizabeth, I'll start off with you. What is your reaction? Because, you know, it's funny. The statement came out. People got really concerned that it was hawkish. The Fed sort of pulled that back a little bit. And then you got the Trump effect as well.
Look, I think it's not unexpected. We were sort of waiting for a pause this time. And by the way, not a lot of the investors here, other than the managers, are really thinking about it. They're mostly thinking about the diversifying assets they want to meet here. But we haven't changed our forecast. We're still expecting 2 cuts this year, 1 in 2026. And the timing's kind of uncertain around that. But we thought it was interesting that they removed the clause about the progress towards the 2% inflation.
Which was, again, not meant to be a signal.
Sure.
He later on said in the press conference. David, from your standpoint, we were chatting in the break, and you're saying that you were waiting for the Trump tweet afterwards, and there you got it. You know, you have the message on Truth Social. But how do you put this all together? Because you have where the Fed is, and it seems like a growing tension between the president and Jerome Powell.
Yeah, I thought there was a chance that Jay could have broke that tension today and maybe said something like we're looking at what deregulation means for inflation. We're looking at, you know, what the tariffs and immigration policies mean. We're kind of coming up with our own versions of it. But he really is playing it as low key as you possibly could. He just did not want to talk about anything related to the new administration. And I thought that was kind of I think he's got to do it at some point. So why not get it out of the way and just start the process? I don't know what delaying it for another 6 weeks does, but you know, that's what he chose to do. He's going to have to step up and start saying things sooner rather than later. And, you know, we're going to be watching these Trump tweets post FOMC meetings probably closer than we're going to be watching the SEP and the statement in the coming months,
you know, if
coming
you
quarters.
listened to or watched Elizabeth over the last year and a half, she was one of the few people that got the inflation story right. And it's still a problem without question. CRB index is at a 15-year high. So is it going to continue to be a problem, I guess is my question.
It could be a problem. I think there's some over-indexing on the tariffs issue. That's only going to add, we believe, about 0.3 percentage points to inflation. But on your point, if it does become a problem, and it's not our base case, but if it does, as you know, Goldman believes that over the next decade, there's a 1 to 7% return kind of bracket there for U.S. equities. And if inflation does stay higher, then you run into the risk of negative real returns. And for the clients I serve, which is mostly U.S. public pensions, that's a massive issue, particularly because, look, last year was a good year for 60-40, but only because of the 60. So there's a lot of hurdles here.
Yeah, David, you know, we keep hearing about this new administration and flooding the zone with all these policy ideas, right?
Yeah.
And it's kind of creating a little bit of uncertainty, or a lot of bit of uncertainty. How do you think about that, right? So we're just talking about Powell at some point is going to have to obviously stand up and kind of stake how they're going to go about this. But all that uncertainty and how the Fed has kind of changed their tune over the last 6 months or so, how do you think it shakes out if we do have interest rates, you know, kind of stick around here at this 4.5 sort of level? How does it play out for equities?
I think the optics actually look pretty bad for the Fed at the moment, and they look a little like he's setting himself up for a 2018 showdown with Trump. And I hope that's not what happens, because that won't be good for equities. I hope he moves the other way. But, you know, the 50 basis point cut just before the election, not good optics. Now, pausing just after the election, not great optics. So I think they've got to kind of really stake out, do they really have this disinflationary view that we're getting back to 2? What is it on? Is it on energy? Is it on the tariffs not being as big a deal, or the immigration not being as big a deal? I think they've got to start taking a stand on all of those issues. By the way, it's not that uncertain. We saw the movie in 17, 18, and 19. We saw tariffs. We saw immigration. We saw exactly what his fiscal policies were. And inflation went nowhere. So it's really hard for me to get my head around a Fed that wants to jump into this, oh my God, there's all these inflation risks I got to worry about, when 3 years of Trump policies produced 2.5% to 3% growth and very little inflation. And then, of course, we got COVID and all bets were off. So I think there's enough history that they could make an educated guess. I'm just a little bummed out that Jay balked so hard this time. I think he had a chance to step in and maybe do something, and he didn't.
There's obviously a lot of question marks still regarding policy and how that's going to impact what the Fed does and the economy, Elizabeth. So what are you telling clients in terms of the volatility that so many people are expecting in the first, 6 months, give it, of the administration?
Volatility is actually a good thing. You sort of want volatility if you want to make money, right? So I think you want to be looking for investments that can make money without calling the interest rate phenomenon correctly. So volatility is good for convertibles, right? And there's a lot of tailwinds behind that, whether in arbitrage or long-only strategies. There's also tailwinds behind private credit. Either way the rates story goes, I know a lot of people think that's a great thing to look at in rising rates, but in a declining rate environment, you can pay off and lower your debt better. And then liquid alts and hedge funds. Anytime there's volatility, relative value trades are the way to play it. And there's a lot of that here today, and that's what our clients are looking for.
Yeah, and in terms of Jay Powell not diffusing that tension between the central bank and the White House, I mean, how are you anticipating that will impact equities immediately?
Look, I'm very optimistic on equities, but I'm very optimistic on equities not because of the Fed. I'm optimistic because I think the deregulation trade is really underappreciated. And I think people are still, the number one question I get in a meeting is, what are you worried about? Are you worried about tariffs? Are you worried about immigration? Are you worried about fiscal recklessness? Everybody's got a wall of worry to climb, and that's usually a great sign for equities. So I think we've underestimated dereg. It's a huge story. The president said it in his speech 2 days ago down here at Doral, or 3 days ago now in Doral. He said, I talk to CEOs every day and I ask them, would you rather have tax cuts or deregulation? Every CEO tells me the same thing. I'll take the deregulation. We should be talking about that so much more. The cutting of the red tape is huge. The tariff stuff, the immigration stuff, these are, to me, much bigger sideshows than the deregulation story. And I think he mentioned that in his tweet after today's Fed meeting, that the bank regulation stuff is really something they want to focus on too, unleashing our industry from under the reins of what was created from 8 years of Obama and 4 years of Biden. Those were big regulations on the financial services industry, Dodd-Frank and everything else, and kind of Michael Barr being out and kind of the next stage of what financial markets look like in a deregulated environment. I'm just really excited. I'm excited for our industry.
All right. Thank you, David Zervos, Elizabeth Burton. Appreciate it. Coming up, China's got one more entrant in the global AI race, a new model from Alibaba that could already be outdoing DeepSeek and what it could mean for the stock. Plus, opportunities in private credit. Oaktree Capital's co-CEO, Armin Panosian, will join us next to detail how moves and rates are impacting the space and where he's seeing the best returns. You're watching Fast Money live from the iConnections Global Alt Conference in Miami, Florida. Back in 2.
Ready for the big meeting?
I have to write this project plan.
I just need to reply to 40 emails.
Every day, your team gets sucked into endless writing tasks. And every day, hours disappear for everyone, except Pam. Hey, Pam. Because Pam uses Grammarly's AI to write in a few clicks, not a few hours. It's one seamless experience everywhere. And it works for the whole enterprise. That's why 70,000 teams trust Grammarly.
I was lost in the dark.
Grammarly for Business. Enterprise-ready AI.
It's not if the markets will turn, it's when. At Howard Capital Management, our proprietary family of funds actively navigates complex market landscapes while seeking to safeguard your tomorrow. We aim to empower investors, delivering opportunities with a tactical, mathematical approach. Start investing with confidence today. Contact your financial advisor and see how Howard Capital Management can redefine your fund experience.
your business is easy once you know the moves. With GoDaddy Websites Plus Marketing, you can quickly create a website and AI will customize it for you. Get your business out there and get more customers in here. No sweat. For you anyway. Create a beautiful website in minutes with GoDaddy.
It's not about looking like you've got it all together. It's about feeling like you do. Make our new sugar for your everyday sidekick. Own your ritual your way with Liquid IV.
Power E-Trade's award-winning trading app makes trading easier. With its customizable options chain, easy-to-use tools, and paper trading to help sharpen your skills, you can stay on top of the market from wherever you are. E-Trade from Morgan Stanley.
When you sell with The RealReal, we handle photography, pricing, shipping, customer service, and so much more. Resale is what we do, so you have time to do you. First-time consignors get $100 extra. Terms apply.
When the temperature drops, you've got two choices. Close your eyes and think warm thoughts, or open your eyes and get out here. There's only one vehicle lineup that embraces everything the cold has to offer. The official vehicles of winter. Jeep, there's only one.
Right now, during the Jeep Start Something New sales event, get 20% below MSRP for an average of $13,000 under MSRP on 2024 Jeep Gladiator Rubicon and Mojave models.
Welcome back to Fast Money. A couple fast movers catching our eyes today. Shares of Alibaba up again today, bringing gains over the past week to nearly 12%. The China tech company releasing a new version of its AI model that they say outperforms DeepSeek. And some more after-hours action here. Shares of IBM jumping after topping EPS and revenue expectations. Las Vegas Sands also sharply higher despite an earnings miss. And Whirlpool dropping after reporting disappointing revenues. ServiceNow, take a look at that, also lower as results come in line with expectations. You guy. Alibaba.
Yeah, well, we play this. What's that game we play?
So many. I don't know which you're talking about.
The one where you put letters to try to make a word that half the people that play have no idea how to play it correctly.
A is not in two.
I am not one of those people.
B is in two.
B is in the two. Yeah. And B has actually done pretty damn well. And you know what? We had Vinny and Porter, and they think Alibaba is probably 40-50% undervalued. And then IBM, real quick. Do you believe in coincidences?
No.
No, neither do I. It's no coincidence. And when Gary Cohn came in, look at what that stock has done. By the way, I think that was the Ian Sandy Kennel's Swift trade a couple years ago.
Last year.
All-time high in IBM. Maybe a little extended, but this has been a great story.
All right, coming up, Starbucks shares brewing up a nearly 2%, two-year high, I should say, as the coffee chain updates investors on its turnaround plan. The changes coming to the menu next. And Oaktree Capital's Armin Panosian helps us dig into the private credit market, where he's seeing the biggest opportunity in the space. Do not go anywhere. Fast Money in Miami is back in 2.
At Ameriprise Financial, we know our clients are so much more than clients. They're go-getters and game changers, legacy leavers and visionaries, healers and confidants. The goals that matter most to you matter most to us. Helping you achieve them is what we do best. With personal financial advice from an advisor you can trust and goal-based investing in solutions, it's no wonder we have a 4.9 out of 5 client satisfaction rating. Ameriprise Financial, advice worth talking about.
Out here, no 2 days are the same. Some days are for breakfast with friends at home, others for going out. At Tractor Supply, we'll help you make the most of life out here, no matter how you live it. Tractor Supply, for life out here.
At State Street, we know everyone's trying to get somewhere. Take the next step toward your future by investing in the S&P 500 with SPY. Getting there starts here.
Why do you invest? To win, obviously. To secure your future. Brokerages can't tell you exactly how. VectorVest can, with 20/20 insight. What to buy, when to sell. Consistent growth, more wins. Find more winners with VectorVest.
But it's not just about the ticket sales. It's maintaining that connectivity with her fans.
The power of a fan base.
She's built this billion-dollar brand.
She's able to do that in a pretty unique way.
The Swift Effect, Part 2, tonight, 10 Eastern, CNBC.
Meet Omnilux Contour, an LED light therapy mask clinically proven to reduce fine lines and wrinkles. Find out how you can improve your skin at OmniluxLED.com.
All right, team, saddle up. I want Q1 full index reports at my desk by noon.
Are you getting any of this?
Yep, Otter's got the meeting notes. I'll ask it for action items in the channel. And Maria already asked for a budget reminder. Smart.
As a judge of my. Got it?
Got it, boss. Otter, you got this.
What's your plan, huh? Do you have one? Talking about what is your plan for a reliable source of power when the next emergency strikes? Well, check this out. It's called the Patriot Power Generator 2000X, and it's from the family over at 4 Patriots. See, they took a page out of the military's playbook for portable solar power, and now we get to use it in our own homes. What's even better is that this solar generator can power critical appliances like your fridge, your microwave, and your CPAP machine, so that you're prepared for whatever emergency strikes next. So go on, check it out. It's over at 4patriots.com.
Welcome back to Fast Money. A new administration, the specter of inflation, and a hawkish Fed may have major implications for credit markets this year. But our next guest says any potential uncertainty could be a huge opportunity. Armin Panosian is the co-CEO of Oak Tree Capital Management. Welcome back. Great to see you again this year.
Good to see you too.
iConnections. Why is that?
Well, anytime there's uncertainty, it creates opportunity for firms that have the depth of expertise and finding that type of idiosyncratic situation that needs a solution. So we're really excited about the uncertainty. We think there's opportunity embedded in it. But in addition, I think because there's some uncertainty around the inflationary policies that President Trump may be taking on, kind of leans on rates being higher for a little bit longer, which is great for credit investors.
Right. Where are we? I mean, are we in a sweet spot right now in terms of rates for the private credit markets? I mean, we just had Elizabeth Burton of Goldman Sachs, and she was saying it's actually better if rates are a little bit lower. You know, your borrowers can pay back better.
Sure. I think there are different types of borrowers. So in terms of consumer borrowers who are below prime or subprime, I think the rates are kind of tough right now. We are seeing some elevated delinquencies in that type of borrower base. But in terms of corporate borrowers, fixed rate borrowers, this last few years have been a pretty good period for them because they've been able to grow with inflation and some of the stimulus. So they're actually feeling really good about life.
Armin, I'm sorry, I was just saying something's happened that's never happened before since September. 10-year yields 3.6, Fed cuts goes up to 4.8 over the course of 5 or 6 months. We've never seen that before. Yeah. Is there a threshold where, you know, rates get to 5%? That's been the number that's been talked about. Things start to get a little dicey in your world.
They do. And I think it's really because there are certain types of assets that are pegged to that 10-year, especially in real estate. I don't know what the magic is on 5%, but it does feel like there is an issue that will become a problem if 5% is the persistent rate on the long end of the curve.
Armin, you said higher for maybe a little longer. So we hear higher for longer as kind of a mantra here. You know, we're at 4.5 in the 10-year. If you had to look out, I don't know if you're a betting man or not. Look out 6 months. Are we 5% or are we 4% in the 10-year?
If I were a betting man, I would say closer to 5%. There's a lot of deficit spending that is planned. That leans on the rates being a little bit higher. We need to be a bigger borrower as a country, but for some pretty significant changes in the buyer base of our treasuries, I think it leans on higher rates.
In terms of private credit, here at iConnections, obviously, you're talking to a lot of potential investors. What are the biggest drivers still driving them to the private credit market as another layer of investment? And what role do treasury yields play in that decision in terms of carving out your basket and deciding within my fixed income basket, within my bond basket, I'm going to go to private credit over something else?
Yeah, it's a great time to be in credit. It's partially due to the rates being high. It's also partially due to some pretty attractive spreads above those base rates. When you compare that against equities, I think the prospective returns on credit are far more attractive because there's a contractual rate of return. The coupon is very powerful. If you look at the forward PEs today and you were to overlay them against history and kind of do a little bit of prediction on what equity markets would return, we think that they'd be inferior to credit in the short to medium term. And that's why a lot of investors are looking at credit because of that contractual return, because the picture for equities is a little bit uncertain. And that's why they're allocating. But in addition to that, they just like the income. I mean, high yield bonds yielding 7%, broadly syndicated loans yielding even more than that, private credit close to 10%. If you're a pension fund that has a roughly 7% payout ratio, it feels really good to be in that sweet spot of credit, of below investment grade credit.
Armin, thank you. Great to see you. Armin Panosian of Oaktree. Coming up, the changes coming to the Starbucks menu as that stock jumps to a nearly 2-year high in the back of earnings. More on the turnaround plan next. And Bitcoin prices hovering near record levels, but taking a sharp leg lower after today's Fed decision. What our next guest says about the pullback and how President Trump's stance on crypto will impact the space. You're watching Fast Money in Miami, live from the iConnections Global Alts Conference. Back in 2.
Thanks. Thank you.
In a world of uncertainty and disruption, how will your investments stay resilient? We've been navigating change for 125 years, always looking forward, anticipating risks, and trusted to manage over $1 trillion in assets worldwide. Solving for the needs of investors today and tomorrow. That's the power of Nuveen.
Introducing Aztec Minerals, listed on the OTCQB and the Toronto Venture Exchange. Gold and silver prices have surged to multi-decade highs, creating a strong backdrop for precious metals exploration. Aztec Minerals is drilling in Tombstone, Arizona, a historic, high-grade silver and gold mining district with significant expansion potential, with additional drill results expected soon. And having private ownership of both surface and mineral rights, Aztec Minerals is positioned for growth. Symbol AZZTF on the OTCQB and AZT on the Toronto Venture Exchange.
Morning, everyone. Ready for the big meeting?
I have to write this project plan.
I just need to reply to 40 emails. Linda? Oh, their date disappeared. Too many emails, messages, docs. That's why I have Grammarly. It's AI that helps me write faster and better everywhere. IT just cleared it for the whole company.
I was lost in the dark.
Grammarly for Business. Enterprise-ready AI.
Only the ServiceNow platform connects every corner of your business, putting AI agents to work for people.
Like secret agents?
No, more like autonomous minions that you control.
To do what?
Well, Jim's agents resolve simple customer issues, and Patty's agents flag network problems.
Proactively?
Yep.
I'm loving my agents. Wait, do you all have agents?
Oh, yeah. And on the ServiceNow platform, everyone's agents work together, so everything works better.
Could I have agents?
Maybe.
Want to apply to be on CNBC's Disruptor 50 list? Is your startup disrupting the status quo? Scan this code or go to cnbc.com/disruptors to apply before February 10th.
Welcome back to Fast Money. Starbucks up more than 8% on the back of its strong earnings report. The coffee chain posting earnings and revenues that beat expectations and announcing it will slash 30% of its food and beverage offers from the menu by the year end. It was the stock's best day, I should say, since last August and its highest close since May of 2023. We talked about this yesterday, Guy, but the move today was really something.
Okay, RONG on this one. And look at the stock that traded almost 40 million shares. It typically trades 8. So the volume was behind it. A lot of people have been out of this trade, obviously poured in. I talked about the 4-year downtrend that I thought was intact. We closed through it today. Good for Starbucks. There's a lot of hopium now, and people believe Brian clearly, but they have a lot of obstacles still, and valuation is not cheap here.
Obstacles like what?
Well, I mean, all the obstacles that they've had. I mean, I think they have a growth problem without question. They have a margin degradation that's been going down. Yeah, I mean, the business is on the other side, I think, and people are saying he's going to, the magic wand that he did at Chipotle, he's going to do at Starbucks. They're entirely different problems.
All right. Coming up, a new world for Bitcoin Galaxy's Steve Kurtz will join us next to detail the latest moves in the crypto space and what a U.S. stockpile could mean for the price of Bitcoin. That is next. More Fast Money live in Miami right after this.
You're seeing Skechers' famous glide step footwear everywhere. And now that famous design is available in hands-free Skechers slip-ins. Get the comfort and style of glide step now with the convenience of slip-ins with no bending down or touching your shoes. Try glide step Skechers slip-ins.
At The RealReal, over 10,000 new arrivals drop every day. So you can shop all this from right here. The best part? It's up to 90% off. The RealReal, authenticated luxury resale. Shop now with code TRR20 for 20% off. Terms apply.
Create tomorrow. Start today. With new investment products backed by superior risk management. Asset management in a time of disruptive change. Financial well-being, accessible to all. Calabas. Today for tomorrow.
I had 8 UTIs in 1 year. This inspired me and my partner Spencer to launch Eucora. Eucora makes effective urinary tract health products.
It truly works miracles.
The peace of mind I've been looking for.
Go to eucora.com to learn more.
Hindsight may be 2020, but what investors need today is 2020 foresight. VectorVest has it.
I'd be trading blind if it wasn't for VectorVest. The best stock site, period.
Test drive VectorVest today for only 99 cents.
Next.
I believe Apple's an amazing company with amazing management. Whatever goes wrong will be fixed. I just don't know when it will be fixed. Historically, you're better off sitting tight than trying to trade this one.
Mad Money, next, CNBC.
Do you have a life insurance policy you no longer need? Now you can sell your policy, even a term policy, for an immediate cash payment.
We thought we had planned carefully for our retirement.
But we quickly realized we needed a way to supplement our income.
If you have $100,000 or more of life insurance, you may qualify to sell your policy. Don't cancel or let your policy lapse without finding out what it's worth. Visit CoventryDirect.com to find out if your policy qualifies, or call 1-800-523-6900. Coventry Direct, redefining insurance.
When things go sideways, will you be prepared? I want to introduce you to the Patriot Power Generator 2000X. Use the endless free power of the sun to power lights, your TV, medical equipment, even run your fridge. And that's without gas, fumes, or noise. Go to 4patriots.com. You'll get a solar panel included free, double the capacity, expandable for more power, and more outlets than ever. This is about peace of mind. Get your solar generator and free panel at 4patriots.com.
Welcome back to Fast Money in Miami. Bitcoin climbing almost 50% since President Trump was reelected in November. The cryptocurrency just off of all-time highs from last month, but still solidly above the 100K level. Galaxy Global's head of asset management, Steve Kurz, joins us now on the crypto landscape. Steve, great to have you with us.
Thanks for having me.
You've been coming to this conference since the inception. How different is the environment now?
You know, it feels a little trite to say this time is different, but it really is. I mean, it's the standing room only crowd for all of the sessions on Bitcoin. I think the best way to explain that, I was at the bar with my wife last night. We had a nightcap. 2 skeptics who were investors were next to me. They spent 30 minutes debating why crypto wasn't real, but they knew everything about Solana, Ethereum, Trump coin, all the meme coins. You're like, this is very different. The starting point is very, very different.
In terms of that incremental sort of party that's interested this year, who is it? Is it the institutions? Is it pensions? Who?
It's all the above. I mean, you have certainly the allocators that now have had work done by the consultants. So the operational due diligence work is done. The pensions are looking. The institutional wealth crowd, which is a $50 trillion market that hasn't yet really come into the space, they now see a 1-year track record on the Bitcoin ETFs. They're starting to take a real look towards investing their client capital in Bitcoin. It's really all the above.
Steve, when you think about it, we've heard a lot of use cases, over the years, and many of them have kind of fallen by the wayside, right? It really has become a store of value. So when you talk about a lot of these big institutions and the demand for it, is it just that? Is it just digital gold?
Well, it's chicken and egg. You need the regulations and a framework to build. Crypto was a back-end technology first. You're going to see an explosion of building on top of crypto now. It's not just digital gold. You have Ethereum and Solana, obviously, but stable coins. What you're going to see is stable coins moving from a $200 billion market cap to $400 or $500 billion. It's a cheaper technology. The settlement is faster. It's found product market fit. We don't need to do anything except to put more fuel on that fire.
Very friendly administration. How important is a Bitcoin reserve?
The Bitcoin reserve it's of course important, but it's not as important as the fact that the war on crypto by the U.S. government is officially over. It really is. You've never seen a 180-degree shift so quickly from one administration to the next. What happened in the last few years is we were talking about what is crypto, then why is crypto important? Now it's how are we going to bring crypto to the U.S.? You got the executive orders, you've got the SEC actions giving you air cover and setting the tone, already bringing builders back to the U.S., but then you have real legislative rolling up your sleeves. We were just in Doral talking to Republican Congress people. Where does DeFi fit on the board? How do we sequence this? How do we get things done this year?
What would be the number one legislative or regulatory catalyst for you for the price of Bitcoin?
Well, we just need to know, for the price of Bitcoin, we need a framework around market structure, and we need an overall what is a security, what is not a security. That's going to help Bitcoin. That's going to help the other coins. That's going to help the front end of crypto be built, like I said.
All right, Steve, great to speak with you. Thank you.
Thank you so much for having me.
Galaxy. We got to get back to Gene Munster here. He's been listening on the Tesla conference call. That stock is at after-hour session highs, up about 5% right now. Gene, what's the latest?
Melissa, 3 key takeaways. First, the robo-taxi service launches in Austin. That's in June. Most people had expected it late in the year. They did say it's dipping the toe into the water. Second is that he described 2026 as a year that's going to be epic, and 2027 and 28 as being ballistic, ridiculous, and bananas. I mean, he just really can't pile the adjectives on more strong. And last is on the CapEx side. He says, given the opportunity around AI more broadly and autonomy and Optimist, a $500 billion infrastructure build-out is justified. So I think it's kind of all systems go, at least for the people that can look past. Not a lot has been said about 2025. I think he's laying the groundwork that give him space in 25 for a breakout in 26.
All right, Gene, thank you. Gene Munster for that update on Tesla. The other stocks pretty stable in the after-hour session in terms of the moves, but Tesla's the one that is moving higher. It looks like somebody used thesaurus.com tonight in terms of ballistic and bananas and using all these different words to describe amazing.
Well, it's just incredible to have that kind of clarity that far out when I don't think a lot of people have clarity what's going to happen over the next couple of weeks. But you know what? If he does, that's why he's being rewarded right now.
Yeah, it looks like they backed away from 2025 guidance that they gave, I think, for growth of 30% or something like that, and they're really kind of back-end loading it. I mean, I think that sort of commentary is kind of bananas, and I don't think that institutional investors really want to hear that sort of stuff. I think the cult stock owners get really excited about it.
Yeah.
It is a $1.5 trillion meme coin. That's what's going on here.
Up next, final trades.
Business. It's not a 9-to-5 proposition. It's all day and into the night. It's all the things that keep this world turning. It's the go-tos that keep us going. The places we cheer, trust, hang out, and check in. They all choose the Advanced Network Solutions and round-the-clock partnership from Comcast Business, powering more businesses than anyone, powering possibilities.
At Morgan Stanley, old school hard work meets bold new thinking. Partnering to unlock new ideas, to create new legacies, to transform a company, industry, economy, generation. Because grit and vision, working in lockstep, puts you on the path to your full potential. Old school grit, new world ideas. Morgan Stanley.
How's the quarter coming along, Kate?
He thinks your name is Kate and hates when people correct him.
Pretty great.
Define pretty great.
We added Coupa's AI-powered total spend management platform, so we're finding new efficiencies and multiplying margins.
So you can mind your business.
So you can mind your business.
No, that's not what I meant.
You all should be laughing harder.
Empower.
So handsome.
I can't buy this. What's wrong?
Hang on there. Actually, you can. Your Empower investment account has performed well, and this whole off-whitish cantaloupe thingy is really working for you. So... Oh! Hot to trot! Nobody says that. Get good at money so you can be a little bad. Empower.
What if there was a cruise that felt like no other? A cruise created by foodies for foodies. One chef for every 10 guests. Every meal prepared to order, and every plate a personal discovery. Welcome to the world of Oceania Cruises, the world's greatest cities and off-the-beaten-path secrets. One memorable bite and toast at a time. It's more than a feeling. It's more than a cruise. It's Oceania Cruises.
Your cardiovascular health impacts everything, and we mean everything. Blood pressure, circulation, and energy production for starters. So here's a radical new approach to cardiovascular health support. From the brand with more 5-star ratings at Walmart than any other beet brand. It's Super Beets by Human, the #1 cardiologist recommended beet brand. Discover how Super Beets cardio-powered ingredients support so much more than heart health. And for a limited time, get a free month supply on all bundles at superbeets.com.
Next.
I believe Apple's an amazing company with amazing management. Whatever goes wrong will be fixed. I just don't know when it will be fixed. Historically, you're better off sitting tight than trying to trade this one.
Mad Money, next, CNBC.
Final trade time. Let's go around the horn. Well, short horn.
It's bananas that Tesla's going to build thousands of Optimists this year, and that robotaxi will be in Austin in June.
I started yesterday's show talking about the crew. I'm going to end it that way.
Yes.
The people behind the scenes have done a remarkable job. The true heroes of the last 2 days of the show.
Especially putting up with you.
GDX, Melissa Lee.
All right. Thank you for watching Fast Money live in Miami. Mad Money starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Kramer. Welcome to Mad Money. Welcome to Cramerica. People, my friends, I'm just trying to save you some money here. My job, not just entertain, but trying to explain all this stuff. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Fraught. That's the word we use in the office for days like today when so much seems to be going wrong. Even if the averages weren't that terrible, Dow declining 137 points, S&P slipping 0.47%, NASDAQ losing 0.51%. We did catch a late-day rally in the averages. Now, we've got a budding revolt against some of the Magnificent Seven. It makes me feel like we're getting closer to the end of the movie. Maybe only 3 of the 7 make it out. Pessimistic. We've got a Fed that seems to be backing off from its optimism about inflation. The economy's too strong to justify rate cuts. Pessimistic? Oh, and there's some incredibly solid action in the healthcare stocks, the telcos, the banks, the transports, and the travel and leisure stocks. Aerospace is on fire. By the way, people, that's a huge percentage of the market. But who cares, right? We only care about tech. I think that that's wrong. Let's break them down, because if this market feels like a minefield, it's a minefield of our own choosing. There are plenty of areas with clear paths if you're willing to look. First, let's take the Fed. Today, Jay Powell once again made it clear that he's looking at the data to figure out what to do next. Sure, a few months ago, they thought that the economy was slowing in an inordinate pace. They spoke about needing to be vigilant because they feared they would fall behind if the economy really took a header. But the economy didn't take a header. Instead, I think the Fed didn't and couldn't predict the burst of economic activity that came with the election of President Trump. You know, it's a little uncanny, is it kind of like a switch was flicked. The optimism came out of nowhere, but the business community was very happy about the election, and their optimism was palpable. Big change from how they felt under Biden. That's why the Fed chief told us today he can't stay as concerned about a slowdown. As he said today, we don't need to be in a hurry to do anything. Now, at another time, we'd be thrilled to hear that message. But there are still tons of investors betting that the Fed will keep cutting rates as the year goes on. They forget that the Fed's data dependent. And right now, the data says do nothing. They thought more rate cuts were inevitable. So then what do? They sell stocks like crazy when they don't hear that the Fed's in a hurry. Remember my view, as long as the Fed's willing to cut if the Fed economy deteriorates, we're in a good moment. We have good earnings, and for that matter, matters more than monetary policy to me. Good earnings makes stocks go higher. Good profits combined with a benign Fed equal higher stock prices. Optimistic, glass half full. You know, I hate those press conferences after the Fed speaks. I mean, that's because the press has to ask the most provocative questions, mostly referencing President Trump's statements about the need to get interest rates down. At one point, I had a job like these reporters. I was early in my career, penniless, living in the back of my car. I always tried to make some sort of wave, something that so threw off the person leading the press conference that I knew my pathetic bosses would be thrilled. They always were. I, as they say, no longer pay for dinner. I don't need to make a splash or even a ripple. I just want to tell the story. And the story is the Fed's going to have our backs if things get weak, not going to be intimidated by the president. The economy gets too strong, Fed won't help us. I see inflation potentially coming down because I think housing costs are coming down, supermarkets getting slightly better, oil's pulling back, auto prices going lower. And that's the data. I like the data. Here's what the press and many investors don't seem to realize. The delusional people want more rate cuts, but the Fed is only willing to give us that in a situation when the economy is falling apart. Fortunately, we're not in that situation. Optimistic. Think about how strong some sectors are. When the Fed slows its rate cuts, that's nirvana for banks. That's where they make the most money. See those stocks? Healthcare's been lagging from far behind. Now I think it's playing catch-up. Travel and leisure, I mean, what a bull market. No top. Which leaves the Mag 7. We always talk about these stocks as if they're invincible. As someone who shared in the creation of the term Mag 7, all I can say is, remember, the Eli Wallach's goons gunned down a bunch of them. Maybe we're near the end of the movie and some of the good guys, James Coburn, maybe Robert Vaughn, have met their demise. How about the ones that reported tonight? Microsoft delivered a strong overall quarter, but the most closely watched figure is the constant currency revenue growth for Azure, their cloud infrastructure business. That missed so slightly. In truth, the success of the quarter will be determined by Microsoft's guidance, and that should come at the end of the earnings call, which is going on right now. I ain't cuffing it. Anyone trading the stock before that's putting the cart before the horse. As for Tesla, as long as Elon Musk is behind the driver's seat, I want to own the stock. He put up soft numbers tonight, but a terrific forecast for 2025. I'll go with that. Musk delivers. Moreover, he makes cars that could become our nation's de facto autonomous vehicle king if his close associate, the President of the United States, opens the federal interstate highway system to Tesla, if only to keep us competitive with China. The best report of the night was easily Meta Platforms, which delivered a colossal top and bottom line beat, tremendous free cash flow. Meta also offered a conservative outlook, lower than expected revenue for the current quarter, but after a quick pullback, investors ignored the guidance, which you have to do, and sent the stock higher in after-hours trading. After seeing what Zuckerberg did in that latest quarter, I think it's right to look past any conservative forecast. Which brings me back to the dilemma of NVIDIA. Right now, we're trying to figure out what's really going on. Is the president going to take action against China, banning the export of NVIDIA chips? So far, that seems to have created a mother necessity situation where Chinese companies say they've developed software that gets much more out of a single chip. So we have the political pressure and earnings pressure from the possibility that companies won't need as many expensive NVIDIA chips if Chinese software gets more out of them than ours. We don't know what's worth. We can't figure out the price-to-earnings multiple. So many are heading for the hills. The only problem, we're going to step on a landmine between here and the hills. I say that NVIDIA and Apple are becoming two of the most hard stocks to own. I myself regard this as one of those moments Thomas Paine talked about. These are indeed the times that try men's souls for both NVIDIA and Apple shareholders. Is there a crisis at Apple? No, it's just facing a belief that in earnings, and more important, its forecast will give tomorrow night. It will be rough. It'll be actually terrible. Sell. NVIDIA, I fear that order cancellations are trying to be priced into the stock. I don't know if it's done yet. When it does, the stocks will buy. I just can't divine that level without more information. I'm not even going to make a claim that I have it. I'd say they're not so magnificent 6, maybe the OK 5. Why don't we wait and see? But the bottom line, if you stop focusing exclusively on big tech, then we got a great market going. And if all you care about is the Mag 7, remember the movie. Make sure you have the survivors and trust that more make it out of the village than we saw in the original. Let's go to Don in Illinois. Don.
Hi, Jim. Thank you for taking my call. I'll cut to the chase. My question is about Eaton. We all know about all the things that have been said about the data centers, and recently there's Chevron and some partners planning for energy for them. What I don't know is Eaton still a good buy at this price?
Well, we bought some earlier during the cataclysm of selling for the trust. Lower, the stock has made a comeback. They do report on Friday. I don't want to play that game of putting a gun to my head and say how they'll do. It's a long-term terrific story, and I'm not going to be distracted from the idea that one of their businesses of the 5 mega trends that they're involved in has gotten a little bit weaker. Let's go to Megan in California. Megan.
Hi, Jim. How are you?
I am good, Megan.
Thank you for taking my call.
Of course.
And thank you for all your help.
Thank
I'm a
you.
first-time caller, and I'm a member of the club.
Thank you.
And my question is, with all this noise about the DeepSeek, are you still as enthusiastic about Dell as you used to be?
That is such a great question. I think about Dell and HPE constantly, like I think about Marvell. Dell has come down a huge amount. I have faith in Michael Dell, but you know what? I also have faith in waiting to see and learning more. And we've got a very fluid situation where all those who claim that they know exactly what's going to happen with NVIDIA or Dell or HPE are, frankly, as delusional as the people that I referenced earlier. You can't know the answer. It's unknowable. And that's where we are. Look, despite the uncertainty we're facing around big tech, there's still a lot to like in this market. Let's stay focused on all stocks, not just 7. On Mad Money tonight, Chili's parent company, Brinker, there's a good example, soared to a new high on its earnings beat. I'm sitting down with the CEO to see what sparked the big appetite for the stock today. Then I kicked off my morning with behind-the-counter exclusive. Yes, I went behind the counter with Kava's founder and CEO. Don't miss this look at what's shaping Kava's post-IPO growth. It's terrific. And later on, controversial, Levi's is on the move after earnings. Market right now doesn't like it. I think the market might be wrong. I've got the apparel company's top brass to break down the quarter. And let's not claim what we know when we don't. Stay with Cramer.